the mangoes. Now you see, now this is the season for mangoes. Mangoes will start. See, in one year, the crop will be very superior, and for everybody is able to afford to buy that mangoes. But in some other seasons, what will happen when at the flowering stage itself, if everything falls down, if the environment is not favorable, then the crop will be very low. Instead of 10 quintals per tree, they will get only 1 quintal per tree. Okay, for one plant. Then what will happen? Automatically the supply will come down, prices will go up. Like that, and the quality also differs largely. So everything is related to the natural environment only, because either directly or indirectly, natural environment only creating everything. Is it that your question, my dear Daniel?
Yes, sir. Thank you, sir.
Right. Any other question? If you have any other question, you can raise. Otherwise, I will go to environmental analysis, because in between I cannot stop. So now, as far as the environmental factors are concerned, if you have any doubt, you ask me. Then otherwise, I will go through the environmental analysis. Any doubt? Okay. Let me go to the environmental analysis. So after knowing what are all the factors that are going to influence, now in order to assess the impact of all these factors, it is essential to us to go through the environmental analysis. So I think now the screen is visible to you. Environmental analysis. Okay? The screen is visible? Hello? Somebody can respond.
Yes, sir.
Yes, sir.
Yes,
sir.
Sir, visible,
Yes,
sir.
sir.
Right. Environmental analysis. What is this environmental analysis means? It is the study of the organizational environment to determine environmental factors that can significantly influence organizational operations. So what is this environmental analysis means? It is the study of organizational environment in which the organization is doing business and how these factors are going to influence the organizational activities. So how to do it? How to do this environmental analysis? By measuring the weaknesses and strengths of the internal environment of the organization and opportunities and threats of the external environment. Or simply, many of you know, it is like SWOT analysis. SWOT analysis. Okay. So don't think that SWOT analysis is environmental analysis, my dear friends. To make you understand in a easiest form, mostly I will go by the common nomenclature. So all of you are aware about SWOT analysis. SWOT analysis means for your individual development also, you should identify your strengths and weaknesses. At the same time, you should identify opportunities and threats in the job market. By that, by choosing appropriate, by having appropriate skill level as your strength, for which opportunities existed in the job market, you can you can have a job. So like that, this SWOT analysis also applicable to the organizational environmental analysis also. How means the internal environment which is within your control, but at the same time you have certain strengths, and at the same time you may have certain weaknesses. Okay. And strengths and weaknesses are internal environment. Under internal environment factors, you have to consider as your strengths and weaknesses. And the external environmental factors, they are only opportunities and threats, because you cannot do anything with that. You have to make necessary changes for the opportunities existed in the market, and you need to prepare your organization in order to meet the threats posed by the society. Okay. So in that way, SWOT analysis you can conduct. So how to conduct SWOT analysis also, that we will go through. Why? Because in order to identify the opportunities and threats, that is macro environmental factors, we can have another analysis like pest analysis that we will go through. Okay. Then coming to this environmental analysis, the purpose of doing this environmental analysis is to identify the factors which will potentially influence the business organizational operations That is the purpose for which we are going through the this environmental analysis. And the environmental analysis influences corporate planning and policy decisions. But there are certain limitations to this environmental analysis also. Why? Because somebody should not think that by doing environmental analysis, everything is being done. Okay, so this is a mechanism, or this is a process for assessing the impact of various factors on business. But at the same time, this environmental analysis is also suffering with certain limitations. Why? Because basically, this analysis we are basing on data. This data will have timeline. That means the data will be keep on changing. That is, information will be keep on changing. See, as the culture adoption is getting changed, technology is changing. Okay, so the environmental factors are changing, the economic factors are changing. How it is changing means, suppose earlier, if you want to buy a car, if you have that 10 lakhs, you can buy a car. But now, if you have 10,000, you can buy a 10 lakhs car on EMIs or high purchasing, so on and so forth. So, like that, the factors are keep on changing. Why? Because this the environmental analysis considers the timeline data. There is a limitation. Whenever the data which we considered for analysis becomes outdated, this analysis also become outdated. So that is the major limitation what the environmental analysis is having. Okay. Then we have to go through the environmental analysis process that we will go through tomorrow's class, next class, because next teacher might be waiting. It is 12. Okay. So I will stop here.
Thank you, sir.
Thank you very much.
Thank you, sir.
Thank you, sir.
Thank you,
Thank you,
sir.
sir.
Very good, sir.
Thank you, sir.
Thank you.
Thank you so much.
Thank you, sir.
Thank you,
Thank you, sir.
Right. Thank you all.
Thank you, sir.
Madam,
Thank you, sir.
coordinator, madam.
Thank you, sir.
Thank you.
Thank you, sir.
Hello. Coordinator. Hello, madam.
Hello, madam.
Adam is yet to join.
Good morning, hello, all of you.
Good morning, ma'am.
Good morning, ma'am.
Yeah, hi, good morning.
Good morning, ma'am.
Good morning,
Good
ma'am.
morning,
Good
madam.
morning, all of you.
Good morning, ma'am.
Good morning, ma'am.
One second, I share my PPT.
Good morning, ma'am.
Can you see PPTs?
Yes, ma'am.
Yes, ma'am. It's visible.
Okay. Yes, ma'am. All of you mute your mics. Last week, what we have learned, basic accounting, accounting principles, concepts, conventions, what is journal, how to prepare journal, ledger, trial balance, and final accounts. Final accounts, trading, profit and loss account, and balance sheet. You have you practiced problems? Have you practiced? Anybody? Do you have any doubt in that?
Yes.
Okay, if you have any doubt in that, at the last 10 minutes, let us discuss about that. Okay. Let us see this session, depreciation and ratio analysis, unit 2. Unit 1, we have completed final accounts, right, with adjustments. Depreciation. What is depreciation? Depreciation means it is the reduction in value of assets. The assets, fixed assets, we are using for long run. It may be 10 years or 15 years, 20 years, whatever it is, right? So every year when we are utilizing for the production, there will be some reduction in value, right? When we are utilizing, the assets value will depreciate. So that is called depreciation. So the depreciation we have to bring into account as an expenditure. It is a non-cash expenditure. Why we have to treat it as an expenditure? Why we have to treat it as an expenditure? Why? Because at the end of the life of the period of the asset, maybe say for an example, machinery we have purchased its lifetime for 10 years. After 10th year, we need to replace the asset. Right? When we replace the asset, we need lump sum money for capital expenditure. So in that case, how to rotate money from if you are taking bulk amount, lump sum amount from your business, that will affect your working capital. That's why every year, part of the assets value we have to allocate and deposit or invest in somewhere. At the end of the 10th year, we can accumulate our money and we can utilize for the purchase of capital expenditure. That means purchase of asset, right? So that is why depreciation we have to bring into profit and loss account. Debit side, it is treated as an expenditure, and also at the same time, its value to be reduction every year. So we have to deduct every year that the amount of depreciation what we are treating it as expenditure, that we have to deduct it from the assets value from the asset side of balance sheet. Every year we have to reduce its value, right? So what are the factors of depreciation? The cost of asset, useful life of the asset, scrap value. These things are very important factors for calculation of depreciation. For accounting, journal entries for depreciation is depreciation account data. See here, depreciation account data to assets account. Then profit and loss account data to depreciation account. These two journal entries related to depreciation. The other entries are related to purchase of fixed assets. When we purchase the fixed assets, journal entry is asset account data to bank account. When we are doing some expenditure at the time of purchase of fixed assets, say for an example, erection of machinery. When we are erecting the machinery, we used to have to pay wages. That is to be treated as a capital expenditure, that value to be added with the asset. The entry is that related assets account data to cash or bank account. Then the sale of events, we have to sell the assets. The journal entry is cash or bank account data to assets account. So these are the journal entries. How to calculate depreciation? The cost of the assets less scrap value of the assets divided by estimated life of the asset. What is scrap value? At the end of the lifetime, if we are selling it for disposing that asset, we will get some money, right? Say 1 lakh worth of machinery at the end of the life of the period, when we are disposing it, just 5,000, 6,000, when we get it. So that is called scrap value. That is to be deducted from your cost of assets while calculating your depreciation. There are a lot of methods for calculation of depreciations are available, right? Straight line method, written down value method, annuity method. These three methods are in your syllabus. Let us see how to do the problems under these methods. There are some other methods also there, that is insurance policy method, machine hour rate method, depletion method, revaluation method, depreciation fund method. Let us see one by one. First one is straight line method. Under straight line method, how do we calculate the depreciation? Simply, cost of the assets less scrap value of the assets divided by estimated of the asset. That is called depreciation under straight line method. Under straight line method, you have to keep it in your mind. The amount of depreciation will be the fixed, or its name is called as, otherwise called as fixed installment method. Straight line method or fixed installment method or original cost method, right? So the percentage of the depreciation, once you calculate, the amount of depreciation will be the same for every year under this method. Let us see this problem. Let us calculate and how to prepare. This kind of problem in your examination point of view may be given for 10 marks question. 10 marks, or if it is a small problem, they may ask you in 6 marks question. Okay. See this problem. B company purchased machinery as follows. Date of purchase, that is 1/4/2006. Cost of machinery is 60,000. 1/10/2006 40,000. 1/7/2007 20,000. So you have to see the accounting period. Accounting period, what is given in your problem. See at the end, assume that the accounting year of the company ends on 31st December. So at the accounting period ending, if it is a 31st period, you have to see how the date of purchase. The depreciation to be calculated from the date of purchase till the accounting end of the period, right? So you should be very careful. What is the accounting end of the period? Date of purchase is very, very important for calculation of depreciation. Then the other adjustments also given here. On 1/1/2008, 1/3 of the machinery which was purchased on 1/4/2006 became obsolete and was sold for ₹6,000. The machinery was to be depreciated by fixed installment method at 10% per annum. Show how the machinery account would appear in the ledger accounts of the company for the years 2006, 7 and 8. Okay, let us prepare this problem. We have to prepare machinery ledger account. Machinery ledger account, first how to prepare. See his machinery account, ledger account. You have to divide into two sides. Left hand side is called debit side, right hand side is called credit side, right? So date, particular amount, you have to put it in that statement, right? First, what we have to enter. So first, when we are purchasing 1/4/2006, let us take it as a first machinery. First machinery we have purchased on 1/4/2006. It's ₹60,000. So what is the journal entry? Bank account data, machinery account data to bank account, that is purchases of machinery. So machinery account debit side, you have to write to bank account 60,000. That is first machinery, purchase of first machinery. Okay. Then second machinery, when you are purchasing 1/10/2006, you are purchasing 40,000. So write it here, 1/10/2006 to bank account 40,000, right? So third machinery is 2007. That let us take it into 2007. First we have to complete the 2006. 2006, at what is your accounting period, ending period? 31st December. right, we have to calculate depreciation for this first machinery and second machinery. So how to write it? See here, what is the journal entry for depreciation? Journal entry for depreciation, depreciation account data to machinery account, depreciation account data to machinery account. So machinery account credit side, you have to write by depreciation. Date is 31/12/2006, that is end of the accounting period. So by depreciation for first machinery. What is the percentage of depreciation is given in your problem? 10%. Show the machinery account under straight line method, that is fixed installment method 10%, right? Fixed installment straight line method, or we can say it is a fixed that is original cost method. These three names are one and the same, right? 10% on 60,000 per year depreciation, how much it will be? 6,000, right? 6,000. But we have to see the date of purchase. Date of purchase is 1st April. We are utilizing this asset from April 1st to December 31st. So how many months we have utilized this machinery? How many months we have utilized? You can answer.
9
9 months. Very good. So April 1st to December 31st, 9 months we have utilized. So 60,000 into 10%. See the workings. 60 for first machinery, 60,000, 10% depreciation is 6,000. We have utilized for 6 months. So, sorry, 9 months. So, how much? 60,000 into 10%, 6,000 into 9 by 12. That is 4,500. Okay. First machinery depreciation is 4,500. Second machinery, when you have purchased 110/2006. 110/2006, that is how many months you have utilized?
3 months.
3 months. Very good. 10, 11, 12. 3 months. See workings. Very good. 40,000 into 10%, 3 months. How much it is? 1,000 rupees. So what is the total depreciation for the year 2006 is 5,500. That 5,500 you have to write it in the machinery account credit side. By depreciation 5,500. Okay. So is there, you have to read the problem, whether anything related to the 2006 is given for 2006. Nothing. So 2006 machinery is so obsolete and sold on 1/1/2008. So when we prepare for 2008, that time we have to write entry for sale of disposing the first machinery, right? So now we have to close this account and at the end of the 2006. So at the end of the year 2006, by balance, you have to close this account. Debit side, how much it is? 1 lakh. Credit side, 5,500. So what is the remaining balance? This is balancing figure, right? 1 lakh minus 5,500. Balancing figure, that is 94,500 is by balance carried down. So that you have to bring into the next year opening balance. Closing balance of this account will be the opening balance of next year. Next year is 2007. 1/1/2007. We have to bring it to the account. That is to balance brought down. To balance brought down. How much it is? 94,500. Right. Let it be. Now we have to see the transaction, whether anything is related for 2007 is given in your problem. Yes. 1/7/2007, third machinery you are purchasing, that is the rupees 20,000 value. So 20,000, 1/7/2007 you have to write entry under the machinery account, that is to machinery account data to bank account or cash account. So how much you are purchasing? 20,000, right? So any other transactions are given in your problem? Nothing. In 2007 is nothing. So now we have to close this account. Before closing, we have to calculate depreciation for 3 machinery. First machinery, when you have purchased 1/4/2006, second machinery, third machinery, you have to calculate depreciation. You have to prepare workings for 2007. That is first machinery 60,000, second machinery 40,000. So totally 1 lakh. 1 lakh into 10% for whole year we have to calculate. First 2006, it is utilized only for first machinery 9,000, 9 months. Second machinery you have used for only 3 months. Second year whole year you are utilizing. So we have to calculate depreciation for whole year. So that is why total we have totaled first machinery and second machinery 1 lakh into 10%, 10,000 depreciation. Okay. Then third machinery, when you have purchased 1/7/2007. So how many months you have utilized now?
6 months.
6 months. Very good. So 20,000 into 10% into 6 by 12. So what is the rate amount of depreciation? 1,000. 10,000 for first and second machinery. Third machinery is 1,000. So totally 11,000 is the amount of depreciation. So 2007 you have to write depreciation. You have to write close end of the period, right? So 31/12/2007 by depreciation account 11,000. So now at the end you have to close this account. Debit side you total it 94,500 plus 20,000 1 lakh 14,500 less depreciation 11,000. The amount is balancing figure is 1,03,500. That balancing figure, closing balance, will be the opening balance of next year. In 2008, you have to bring into account two balance brought down 1,03,500, right? Now, we have to read the problem. What are the adjustments are given? On 1/1/2008, 1/3 of the machinery which was purchased on 1/4/2006 became obsolete and was sold for rupees 6,000. So that means what? By first machinery you have purchased 60,000, out of which 1/3 of its machinery value. What is its 1/3 of its value? 20,000. 1/3 of its value will become obsolete and we are scrapping it and sell it for rupees 6,000. So we have to calculate what is the profit or loss on sale of this obsolete machinery. We have to calculate, and then what is the depreciation for first machinery, rest of the machinery, and the second machinery, third machinery. We have to calculate depreciation. Come to the workings. 2008 first machinery, that is we have to take only 2/3. 1/3 become obsolete on 1/1/2008 January itself. Suppose 1/3 or 1/4/2008, if it is become obsolete, you have to calculate that obsolete machinery 3 months depreciation. So in this case 1/1/2008 first January itself. So you have to take only 2/3 of the machinery depreciation for whole year, right? So 60,000 its value. What is its 2/3? 40,000. So 40,000 into 10% depreciation for whole year 4,000, right? Second machinery and third machinery. Second machinery value is 40,000. Third machinery value is 20,000. So totally 60,000 whole year depreciation you have to calculate. 60,000 into 10%. That is
1,000.
6,000.
Suppose 6,000, yes.
6,000. It is wrong. One second, I will correct it. 6,000. So totally 10,000, right?
Yes.
Now the depreciation for the year 2008 is 10,000. So right here by depreciation account 10,000. So see here, now let us calculate profit or loss on sale of machinery. So we have to find out what is the book value of the asset at the time of sale. How to calculate book value of the asset? Cost of machinery at the time of purchase less depreciation for the utilizing period. So what is the cost of machinery on 1/4/2006? We have purchased 60,000. You have to take only 1/3. 1/3 of machinery or value is 20,000, right? Depreciation for 2006, 20,000 into 10%, 9 months, right? So 1,500. Depreciation for 2007, 20,000 into 10%, 2,000. So total depreciation, what you have utilized for the obsolete machinery is 3,500. So 20,000 minus 3,500, the balance is 16,500. That is the book value of the machinery on 1/4/2008. Okay.
Madam, I think this is 1/1/2008, right? I think dates also to be corrected because
Yes,
we're talking about
yes.
right.
1/1/2008. This is not cost. Book value of the machinery. book value of the machinery on 1/1/2008 is 16,500. So
Next line also date has to change. Okay.
yes, date is
Next.
1/1/2008. So how much it is? 16,500 is the value of the machinery. You are selling only 6,000, right? So what is the loss? 10,500 is loss of sale of machinery, right? 16,500 is the book value of the asset value, but you are become obsolete and you are going to sell out of rupees 6,000. So its value now, loss on sale of machinery is 10,500. So now the 10,500, how to write the journal entry in the machinery account, ledger account credit side, 1/1/2008 by bank. Sale of, at the time of sale of machinery, what is the journal entry? Cash or bank account debtor to machinery account. So by bank account, sale of machinery is 6,000, right? That loss on sale of machinery we have to write by transfer it to profit and loss account. So what is the journal entry for that? Profit and loss account debtor to machinery account, that is 10,500. Suppose instead of loss, if it is a profit, how to write the entry? Instead of 6,000, you are selling 20,000, right? So not 20,000. We can sell it is 17,000 we can have, right? If you are selling 17,500, that is 1,000 rupees profit. Its book value is 16,500. You are selling 17,000. So 500 is profit. That profit we have to write it in the machinery account debit side to profit and loss account. Profit on sale of machinery 500, right? If it is a profit, you have to write under the debit side of machinery account. Loss means you have to write by loss on sale of machinery or profit and loss account 10,500, right? Do you understand this? See, you read your problem. Is there any other transactions are given? Nothing. So now we have to close this machinery account at the end of 2008. 1,03,500. This side we have to 26,500 deductive. 1,03,500 minus 26,500. So that is balance carried down. That is 77,000. The value of the machinery account at the end of the year 2008 is 77,000. That's all. This is the problem you have to prepare in the examination for calculation of machinery account, preparation of machinery account, right? The answer is, so depreciation amount is answer, and then book value of the asset. Balance carried down is the book value of the asset, right? So if you have done any mistake in anywhere else, the step mark is there. But once if you have done mistake in the first year depreciation itself, so everything will goes wrong. So be careful to calculate this depreciation. Okay. The same problem let us do under diminishing balance method or written down value method. What is written down value method or diminishing balance method? That means the depreciation rate is fixed. Fixed percentage will be given, 10% or 10%, whatever it is. But we need to calculate the amount of depreciation on the value of reduction in value. Reduction in value means cost of the machinery less first year depreciation, book value. Book value of the asset, you have to calculate depreciation for second year. Third year, you have to calculate book value of the second year. Second year value minus second year depreciation, that is book value for third year. So that book value of the asset, you have to calculate depreciation. The asset value, you have to calculate depreciation under written down value method or diminishing balance method under the book value of the asset, not cost of the machinery. Straight line method, you have always every year you have to calculate on cost of the machinery, you have to calculate. Here you have to calculate only the book value of the asset, right? Let us see how to calculate. The same problem under written down value method, you will then only you will understand how the difference of depreciation amount and profit or loss on sale of asset or book value of the asset, how it will be shown in your machinery account, right? Let us calculate. See, same entry to bank or bank account, purchase 60,000 first machinery, second machinery, to bank 40,000 on 1/10/2006. Come to the credit side, buy depreciation. First year will be the same. See the workings. First year 60,000 into 10% into 9 months 4,500. Second machinery 40,000 into 10% into 3 months 1,000. So total depreciation 5,500. First year will be the same under straight line as well as diminishing balance method, right? The value of the machinery is 94,500. You have to bring it to the 2007. So when you have to calculate 2007, see the workings. What is the book? You have to calculate depreciation on book value of the asset. What is your book value for first machinery and second machinery? 94,500 is book value, right? Both first machinery and second machinery. That is the book value. You have to calculate 10% depreciation on 94,500. So 94,500 into 10%. That is 94,500. First year 94,500. So 94,500 into 10%, 9,450, right? Second year, see here, third machinery, when you are purchasing to bank 1/7/2007, 20,000, you have to as usual, you have to calculate 6 months. 10%, 20,000 into 10% into 6/12, 1,000 rupees. So total depreciation for the year 2007 is 10,450. See here, 10,000, 10,450 is the depreciation amount, correct? 10,450. So what is its balance? Now yes. Total depreciation 10,450 in the year 2007. So this year total it 1,14,500 minus 10,450. Hello, who is that? Unmute. Sorry, mute your mic. Anybody, can you say the answer? 1,14,500 minus 1,04,000. You deduct it and tell me. 14,500 minus 10,450. Can you calculate and tell me? $10,000. 1,04,050. 50. 1,04,050. We have made some mistakes here. Okay. 1,04,050. So that is the closing balance for the year 2007. For the year, that will be the opening balance for 2008. So 2008, how to calculate amount of depreciation and profit or loss on sale of machinery. See here workings. 2008, we have to calculate depreciation for first machinery for 2/3 machinery, not 1/3. 1/3 we are going to sell, right? So 2/3 book value, how we have to calculate? 60,000 first year. Depreciation is first year depreciation is 4,500 for 60,000. So book value is 5,500. Second year depreciation amount is 10%. So 5,550. The book value of total machinery is 49,950. Right? For first machinery, book value on 1/1/2008. 49,950. What is its 2/3 value? 49,950 into 2/3. 49,950.
33,300.
33,300. Correct. So 33,300. You have to calculate 10% depreciation for whole year. Right? So whole year is 3,330. For second machinery, What is its book value? First year, that is 40,000 first year cost of the machinery. First year you have calculated 1,000 rupees depreciation. Deducted book value is 39,000. Second year depreciation 10% is 3,900. So book value is 35,100. 35,000. Somebody mute your mic. Some noise is coming. You listen very carefully, otherwise you cannot understand the problem, right? Listen very carefully. This 35,500, have you got it? The book value of the second machinery is 40,000 cost of machinery minus depreciation for 2006 minus depreciation for 2007, 3,900. So book value is 35,100 into 10%, that is 3,510 for second machinery. Third machinery, when you are purchased, third machinery, 20,000 on 1/7/2007, right? So 20,000, 1,000 rupees you have depreciated in 2007. So book value is 19,000 into 10%, 1,900. So these three depreciation amount you have to total it. That is the depreciation for 2008. So how much is it correct? 8,740 or 1417. Okay, correct. 8,740 is the total amount of depreciation for 2008. Let us see how to calculate profit or loss on sale of machinery for 1/3 of the machinery. So 1/3 of the cost of the machinery value is 20,000. Less first year depreciation we have to calculate for 9 months. So 20,000 into 10% into 9 months, that is 1,500. The book value is then second 2007, how much it is? 20,000 minus 1,500. Book value is 18,500 into 10% for the 2007. So book value is depreciation for the 2007 is 1,850. Now you have to calculate what is the book value of the cost of machinery on 1/1/2008. 1/1/2008, 16,650. Is it correct? 20,000 minus 3,350. Book value, not cost. This is book value. Book value of the machinery on 1/1/2008 is 16,650. So what is your loss on sale of machinery? Sale value 6,000. So what is loss? 16,650 minus 6,000, 10,650. Come to the machinery account. By bank account 6,000. By profit and loss account, that is loss on sale of machinery. Loss on sale of machinery 10,650. See here, now you have to total these things. Here 1,04,050 minus 6,000, 10,650 minus 8,740. So what is your balance? Can you calculate? 1,04,050 minus 16,650 minus 8,740. 78,660. Yes, 660. Correct? Do you understand this now?
Yes, ma'am.
Can you make difference between straight line method, how to calculate under straight line method, and the written down value method? See here, straight line method, what is the book value of the machinery is 77,000. Under written down value method, book value 78,660, right?
Yes.
Can you make the difference?
Yes, ma'am.
Okay. Any method, either straight line method or written down value method, definitely will, or annuity method. Under these three methods, definitely one problem will be there in your question paper, either in 10 marks or 6 marks. Okay. When we go for next method, annuity method. I have done some other problems also, you practice it. Okay. Under annuity method, what is annuity method? Annuity method means
Ma'am, excuse me, ma'am.
Yes.
Can you explain one more time, ma'am?
Which method, ma?
Before we have seen this roughly. Can you explain me, ma'am?
No. What you want? Standard straight line method or return on value method?
Return on value method, ma'am.
Okay. Return on value method, you have to calculate the amount of depreciation on book value of the asset. Book value means what? Cost of the machinery less depreciation. First year, straight line method or return on value method will be the same. We have to calculate the rate of depreciation on cost of your machinery. That will be the same, right? Second year, you have to calculate the depreciation based on your book value. Book value means what? Your cost of the machinery is 1 lakh, right? First machinery 60,000, second machinery 40,000. So totally 1 lakh. 1 lakh into 10%. If it is a straight line method, we have straight away calculated 10,000. See this straight line method, amount of depreciation 10,000. See 10,000 here, right? This is 10,000 for under straight line method. But under return on value method, we have to calculate only on book value of the asset. That means cost of the asset less first year depreciation. First year 94,000. First year depreciation is 5,500. 1 lakh minus 5,500, that is 94,500. So 94,500 into 10%, that is depreciation for second year. So second machinery, third machinery, 6 months as usual you have to calculate, and total you have to put it in the machinery account credit side. So in the third year, when you are calculating for third year, sale value, you have to calculate what is profit or loss on sale of machinery. For that purpose, we need to calculate depreciation for 1/3 of machinery separately and 2/3 of machinery separately. Why? Because the value reduction in value we cannot take as a whole, as a 94,500, right? So that is why we have split into in different category as first machinery, second machinery, and third machinery. First machinery, its cost value is 60,000. Only we have to calculate depreciation for 2/3 value for whole year. Why? Because we are selling on 1/1/2008. That you have to keep it in your mind. Okay. So 1/1/2008, you have to take 2/3 value. How to take up 2/3 value? Book value you have to find out. So 2/3 value is 40,000, or straight away you can depreciation what you have calculated, deducted. 60,000 into minus 4,500. First year depreciation deducted. Book value is 55,500. Second year depreciation 5,500. Sorry. Second year depreciation, you have to calculate 55,500 into 10%. That is 5,550. Okay. So what is the book value? 49,950. 2/3 machinery book value. Sorry. Whole machinery. First machinery book value is 49,950 on 1/1/2008. We need to calculate on book value of 2/3 machinery. So 49,950 into 2/3 is 33,300. So 33,300 into 10%, that is 3,330. Second machinery, you have to calculate 40,000 minus 1,000. Book value is 39,000. 39,000 minus depreciation 10%, 3,900. So book value is 35,500. 35,100 into 10%, that is 3,510, right? Third machinery depreciation 20,000 minus 1,000 you have already calculated, that you have to deduct it, and 19,000 book value 10% you have to calculate, that is 1,900. So total depreciation all these three machinery is 8,740. That you have to write it in the machinery account credit side, right? 8,740. So how to calculate profit or loss on sale of machinery? 1/3 machinery cost value is 20,000. Less first year machinery depreciation is 9 months. 20,000 into 10% into 9 months, that is 1,500. So the 18,500 is the book value. You have to calculate depreciation 10% on 18,500, that is 1,850. So what is the book value? Now 20,000 minus 1,500 minus 1,850. That is 16,650. You are selling 6,000. So what is the loss? 10,650 is the loss on sale of machinery. Machinery account credit side you have to write by profit and loss account 10,650. So now do you understand what is the book value of machinery under written down value method is 78,660. Right?
Okay, ma'am. Okay, thank you, ma'am.
Okay, ma'am. Let us see annuity method. Under annuity method, we have to calculate depreciation on annuity value. Rate of interest will be given for useful life of the asset, and annuity table you have to refer annuity table for what is the lifetime of the period, how many years, that you have to take the annuity points. Why we have to take annuity points? Why? Because we have to calculate internal rate of return method. So what is internal rate of return? That means you are purchasing 1 lakh worth of machinery, right? So you, instead of investing in your business, purchase of machinery, that 1 lakh if you are depositing in bank or investing in some other marketable securities, you will get some minimum rate of return. That is deposit. If you are depositing your money in bank, at least 5% interest you have to earn, right? You would have earned from your bank, right? Interest. So
Yes.
That is called minimum rate of return or internal rate of return. This one you will elaborately study in second semester financial management. Under financial management, how to calculate this IRR, NPV, all these things you will find out. So now let us see only the annuity table. So what is the amount of interest you would have earned instead of investing in your business? Some other marketable securities are deposit in bank. That is called a minimum rate of return. So what is the cash profits? You have to calculate what is the money value at the end of the first year. Every year you know very well, this year you are investing 1 lakh. What is its value? Money value. Money value reduce year after year, right? At the end of the 5th year, money value will be 1 lakh, will not be the value, it will be more, isn't it? So say for an example, you are purchasing any example, we can say anything else, mobile or whatever it is. One machinery you are purchasing this year 5,000. The same machinery we cannot purchase at the end of the 5th year. Its marketable value will be maybe for 10,000 or 15,000, not at the same 5,000. That means what? The value of the money become reducing, right? So we have to calculate what is the annuity value at the end of the 5th year. That is why the annuity table, that not only from the cost of asset, you have to calculate what is the cash proceeds from your machinery. So what is its annuity value? That is why the depreciation under annuity table you have to take, right? So for this annuity, under annuity method, journal entries I have given: charging interest on asset, that is assets account data to interest account. Depreciation is depreciation account data to asset account or provision for depreciation account. Transferring to profit and loss account is profit and loss account data to depreciation account. Every year that interest is charged, and that should be transferred to profit and loss account. So interest account data to profit and loss account, right? So this is the journal entry under annuity method. Let us see here this problem, you will understand this. A Limited purchased a 5 years lease. Generally, this annuity method will be calculated for leasing the assets, right? The value of the assets should not be changed year after year. That kind of machinery we used to calculate annuity method, right? 5 years lease on 1st April 2013 for rupees 5 lakhs. It is decided to write off depreciation on lease using annuity method. The rate of interest is assumed to be 6% per annum. Rate of interest, that is minimum rate of return, right? The annuity for rupees 1 for 5 years at the end at 6% interest is 0.237396. This is annuity value will be given under the annuity table. Suppose this value, if it is not given, you have to get statistics books, that is annuity table book. Under that you have to see 6% for 5 years, 6% interest for 5 years, you will get this value, right? So this value, if it is given in the problem itself, it is very easy to calculate, right? Prepare the lease account and profit and loss account for 5 years. So amount of depreciation you have to calculate every year, that is value of the cost of the machinery, that is 5 lakhs into this rate of annuity value. Annuity value is 0.37 into 5 lakhs. That is the amount of depreciation. Its value for 5 years. You have to calculate for 5 years. So 5 lakhs into 1 lakh this value, annuity value, if you calculate, that is the amount of depreciation. See here, this is the lease account, machinery account. That lease account you have to prepare, ledger account. At the end of the first, you have to write entry as usual to bank account 5 lakhs on 1st April. What is your accounting period? Accounting period is 1st April you are purchasing. You have to watch accounting period. So here accounting period is not mentioned December or nothing is mentioned. So let us assume 1st April to 31st March taken as accounting period. Okay. Right? Nothing is mentioned. You take it as because 1st April you are purchasing. So first year depreciation, you have to start with April 1st to bank account 5 lakhs, right? Credit side by depreciation 1,18,698, right? So for this, you have to need to calculate interest. How to calculate interest? That is 6% on 5 lakhs. You have to calculate first year interest is 5 lakhs into 6%, that is 30,000. So lease account debit side you have to write to interest account. For interest you have to write 30,000. Now you have to close this account 5 lakhs 30,000. Balance is 4 lakhs 11,000 something, right? Second year you have to bring this book value to balance brought forward. Second year, the under annuity method, the amount of depreciation will be the same for all the year. No need to calculate every year, right? Once if you have calculated under annuity table value into cost of the machinery, that will be the same for 5 years, right? So by balance, interest will be the differ. Why? Because first year annuity, that is interest, you have to calculate only on the value of book value of the machinery. First year cost of the machinery 5 lakhs into 6%, 30,000 interest, right? So now you have taken out depreciation 1,18,000. You have taken out and deposited in somewhere else. Okay, remaining book value of the machinery now 4,11,302 into 6% interest you have to calculate, that is 24,678. So now you have to close this account. Every year you have to 5 years you have to calculate like this. At the end of the 5th year, your balance lease account ledger balance will be the zero value, right? So total amount of depreciation is obsolete, right? See here now profit and loss account you have to prepare. Profit and loss account, debit side depreciation is treated as an expenditure. So debit side you have to write depreciation amount. Credit side you have to write only the interest account. Only no need to close this profit and loss account every year, because it is one of the item will be shown under profit and loss account. Just you have to show how it will be shown in the profit and loss account. That interest, minimum rate of interest, if you are investing in somewhere else, that is the income, treated as an income for your business. That is why we are crediting under profit and loss account, right? 2013-14, that is 30,000. 14-15, 24,678. That what we have calculated here, that you have to write it under profit and loss account. Okay. Do you understand this? All of you?
Yes, ma'am.
If you have any doubts, you can ask me. Let us discuss. Then after lunch break, we will discuss ratio analysis. Ratio analysis, it is a very big chapter. examination, just so many ratios are there. I have given it here. What is the ratio? What is the formula? Everything explained here. If I explain everything, it will time is not sufficient. So simply briefly, I will explain what are the kinds of ratios, what are the important ratios, and straight away I will go for preparation of problems. How to prepare, how to, if balance sheet and trading profit and loss account is given, how to calculate the ratio. Sometimes ratios will be given in your problem, how to prepare statement, right? So missing figure you have to calculate. So many things are there. So let us speed up our class, then only we can complete. Do you have any doubt related to this depreciation accounting?
Ma'am,
Yes.
shall we get this PPT in the website?
Website we have sent to upload to the computer section. Due to some technical problem, we will with short period we will upload. Okay, don't worry.
Okay, thank you, ma'am.
Or otherwise we will put it in WhatsApp group. Okay.
Ma'am, there's one clarification required. In your previous class, you mentioned about in final statements as trading, right? But in books, it's mentioned as income. Both are same or different? In books, when I go through course material, it's talking about income statement. Income or income. Which one is correct?
Actually, but practically what we are using, trading profit and loss account is the correct one. That is income and expenditure we usually calculate for non-profit organization. Non-profit organization, they only receive receipts and payments. That we can say is a receipts and payments account or income and expenditure account, or some international accounting standards. The foreign accounting standards, they are following it as a income and expenditure. Nothing, one and the same. No, don't worry about it.
Okay, exam point of view, which one we should follow? I mean, they will be explicitly asking on trading or income, right? So we can use the same name.
Trading, follow trading profit and loss account. It is
Okay,
not Indian accounting standard. It is usually we used to follow. Even if you write income expenditure, that is also not a wrong thing. It is a correct thing. But exclusively that income and expenditure we used to we use in the non-profit organization.
Okay, clear, man.
Service-oriented concerns, right?
Thank you. Thank you.
This is sole proprietary concern. In case of companies, assets, liabilities, we used to say share capital, that format, everything is totally different. Okay. So in case of companies, this is in case of partnership. Partnership companies also similar to this. Only you have to take up the partners' capital and their drawings individually. But one of the items which will be shown under trading profit and loss account and balance sheet will be the one and the same. Okay.
Okay, thank you.
One more thing, under final statements, one more statement is also there. That is trading profit and loss account one statement, so trading account one statement, profit and loss account one statement. Another statement is profit and loss appropriation statement. Profit and loss appropriation is nothing but companies, they used to follow that. Profit and loss appropriation account will be shown net profit in the credit side. Debit side, you have to transfer what are all the reserves. General reserve, if you are transferring to general reserve 10%, out of that net profit, you have to transfer it in the debit side. General reserve or dividend, if you are declaring dividend to your shareholder, you have to write in the debit side, and then payment of taxation, the rest of the amount transferred to balance sheet, right? That is one more statement is also there. Generally, that statement we used to follow in case of companies. Okay.
Okay, ma'am.
One more doubt here actually. This amount of depreciation in the last example, no? It's 1,118. That need to be deducted from this asset for every year.
Yes, every year you have to deduct. Last, at the end of the year, the book value become obsolete. Zero. See here. Because 5 lakhs cost of machinery, we are dividing equally into 5 years based upon your annuity value. The amount of depreciation is equal 5 years. So at the end of the 5th year, its value is 0. Suppose Scrap value is given in your problem. Scrap value, say for an example, 5,000 is given. So 5 lakhs minus 5,000, 4 lakhs 95,000 into the stable annuity value you have to calculate. Okay. Scrap value, suppose if it is given, you have to deduct it.
Okay, madam. Thanks. So one more thing, like if you could demonstrate once again this final account, then it will be
final accounts. Once again, you want to?
Yeah, like balance sheet and all, no? Balance sheet, trading account, and the example. If you can go through once again with the different example, then it will be
okay. What you do one thing. Previous year's question papers already it is in our website, right? You download it. Final accounts you go through. Final accounts what under our method you prepare it. If you have any doubt in that, you practice 4 or 5 problems, right? You will come to know which item is to be how to treat it. Say for an example, bad debts, exclusively bad debts. If we have time at the end of our last class, I will teach you once again that bad debts adjustment. That is very, very important. Old provision, if it is given, how to adjust it. New provision, if it is given, how to adjust it. That is very, very important adjustment. That kind of one problem I will prepare for you at the end of because we have lot of topics. Ratio analysis, fund flow analysis, cash flow statements. So many things are there. Cost sheet, and then marginal costing statement. All the units are equivalent, equally will be given as questions in your examination point of view. So at the end, if we have time, they will work out one more problem. Okay.
Okay, madam. Thanks.
Then anything else?
Madam, like in case in a real-time example, the machinery is something like you're saying like it is part of capital. But in case like, for example, if I take an EMI or if I take it as a loan, whether that scenarios will be considered here because I'll be paying an interest. Okay.
That the interest is treated as an expenditure that will be shown in the profit and loss account debit side.
Okay.
That is loan.
Okay.
That will not reflect in your value of the asset.
Okay. Okay. Fine.
That is separately treated as an expenditure.
Okay, that will be like
that is revenue expenditure. Yes, that is revenue expenditure. Capital expenditure, you read the revenue expenditure and capital expenditure difference. When will be the asset value will be added at the time of purchase of machinery. If you are paying for erection charges, that is to be added with the value of the asset. That is capital expenditure. Okay, payment of interest for getting loan. So that is treated as a revenue expenditure that will be shown in the profit and loss account debit side. Right?
Yes, ma'am. Yes, madam. Got it.
Then any other doubts?
I think we can break for lunch, ma'am.
Okay. Okay. Thank you. After lunch break, let us go for ratio analysis. Okay.
Thank you.
Okay. Thank you.
Thank you.
Thank you, ma'am.
Okay.
Thank you, ma'am.
Okay. Thank you, ma'am.
Thank you, ma'am.
Okay. Thank you.
Thank you, ma'am.
Okay. Thank you.
Thank you, ma'am.
Thank you, ma'am.
You practice.
Thank you, madam.
When you practice many problems, then only it will be easy for you. Right? Practice is the main important for problem oriented papers. Last minute you cannot study. When you are practicing different problems, then only you can learn how to treat the adjustments, where it will come. So many doubts arise. Okay.
Okay, ma'am.
Madam, course material has a lot of mistakes. Course material which is given, the book has a lot of mistakes.
Oh, that we will make it correct. Don't worry. Okay, bye. Let us see after lunch.
Thank you, ma'am.
Good afternoon, all of you.
Good afternoon, ma'am.
Good afternoon, ma'am.
Good afternoon.
Good afternoon, ma'am.
Good afternoon, ma'am.
Good afternoon. Welcome back. Shall we
Good
start?
afternoon.
Shall we start now?
Yes, ma'am.
Yes, madam.
Okay. Let us see ratio analysis. What is ratio? Ratio means the relationship between two numbers. In case of arithmetical expression, we can say it is a relationship between two numbers. How it is useful for accounting? In accounting, final statements, trading, profit and loss account and balance sheet we are preparing. That gives only expressing, it gives the what is the profit or loss, what is the gross profit, what is the financial position, what is its liability, what is its assets. Only that gives the information to outsiders as well as insider of the company, right? Based upon the statement without any interpretation, this statement will not give any interpretation. So we need to compare previous year and current year, or horizontally this company to similar company. We need to compare two statements, and then we have to interpret the statements in various point of view. So for decision making point of view, or investors, shareholders point of view, what is the solvency ratio, what is the this one liquidity ratio, what is the profitability ratio. So these things are important for the interpretation of final statements, right? So this ratio analysis gives the interpretation of financial statements to both insiders as well as outsiders, for the shareholders, investors, creditors. Those who have supplied on credit, they can see their liquidity position, when they will give. So like that, so many interpretations they can gain with the analysis of ratio analysis, right? This ratio analysis gives you various objectives and benefits. That is, I already explained you what is the operational efficiency of the business, what is the financial strength, what is the liquidity position of the company, what is the solvency ratio, so what is the interest coverage ratio. So like that, so many objectives and then benefits you can arrive from this ratio analysis. These ratio analysis are classified under various categories. That is liquidity ratio, solvency ratio, or we can say it is a leverage ratio, activity ratio, profitability ratio, interest coverage ratios. So liquidity ratio is nothing but what is the current assets, is it sufficient for payment of current liabilities or not? That is liquidity ratio. How much current assets, how many times if it is available, is it sufficient or not? So that is called liquidity ratio. Under liquidity ratio, three types of ratios are there: current ratio, quick ratio, and absolute liquid ratio. Current ratio is in terms of current assets and between current assets and current liabilities. So if current asset is, if you have 2 times current liability, you can pay for your, it is sufficient to pay for your current liabilities. That is its general norms: current assets divided by current liabilities, right? Current assets divided by current liabilities. If it is 2 times of current assets, you can pay for your current liabilities, 1 time of your current liabilities. Liquid ratio or acid test ratio or quick ratio, that means liquid assets, the relationship between liquid assets and then liquid liability. What is liquid asset? Current, if you eliminate stock from current asset, that is called liquid asset. Liquid liability means from current asset, current liability, eliminate bank overdraft and prepaid expenses. If you eliminate that 2 items, that is called liquid liability. Liquidity means what? At the quickly converted into cash. Your current assets should be easily or quickly convert into cash. That is called liquid asset. Stock, it will take some time for realizing as cash, right? So liquid asset means eliminate the stock from your current assets, prepaid expenses, stock and prepaid expenses. From current liability, you eliminate bank overdraft. Okay. Then absolute liquid ratio, only you have to take cash in hand, cash at bank, and short-term marketable security. Only these items you have to take in terms of current liability. That is absolute liquid ratio. Leverage ratio. So leverage ratio, or we can say it is a solvency, long-term solvency ratio. The leverage or long-term solvency means debt equity ratio. What is the company's ability to pay for your current long-term liability? That is debt equity. Equity means capital, owner. Owner capital is how much is sufficient for your pay for your liability, long-term liability. So debt equity ratio. As well as we can say what is the proprietary ratio. So these ratios comes under leverage ratios. Activity ratio. Activity ratio is nothing but efficiency, measuring the efficiency of the organization. So efficiency means we can say what is the stock turnover ratio. Stock turnover efficiency, how many times your stock is realizing, that is stock turnover ratio. And then working capital ratio, credit turnover ratio, debtors turnover ratio. So these are the ratios measuring the efficiency of payment as well as receivables, and then stock, working capital. So these are the ratios we are going to calculate under activity ratios. Profitability ratios, we can measure the ratios between the, what is the profitability, that is gross profit ratio, net profit ratio, then long term, that is interest on capital employed. So capital employed, what is the profit on capital employed, what is the ratio. So these are the things comes under. And then profitability ratios. Coverage ratio, interest coverage, long-term debt, what is the interest, whether is it covered out of your profit. So we have to calculate, we are going to calculate under these categories. Okay. Let us see one by one. First one is liquidity ratio, current ratio. Under that, current ratio, quick ratio, or liquidity ratio, absolute cash ratio. Right? First one, current ratio. The formula is current assets divided by current liabilities. Quick ratio, current quick asset, or quick asset divided by current liability, or quick liability. Quick ratio, that means it's nothing but you have to eliminate stock and prepaid expenses. The current liability, you have to eliminate only bank overdraft and cash credit. So if it is 1:1 accounting standards, if current liquid asset one time is sufficient to pay for your liquid liability. Absolute cash ratio, cash in hand, cash at bank, and short-term marketable securities divided by current liabilities. Okay. So many formulas I have given here. If I explain on every one, it will take too much of time. Straight away, let us go to problem. You will come to understand all the ratios. Okay. See this problem. Balance sheets are given. You are required to calculate liquid ratio, debt equity ratio, solvency ratio, stock of working capital ratio, right? So first let us see liquid ratio. What is the formula for liquid ratio? Liquid asset divided by liquid liability or current liability. You can say sometimes liquid liability and current liability may be one and the same when bank overdraft is not available, is not given in the problem, right? So in this case, what are the liquid assets? You see your asset side, debtors 2 lakhs, cash 1 lakh. Only these two items. Stock you have to eliminate because stock is a current asset. We are taking only liquid asset. So debtors 2 lakhs, cash 1 lakh. Then liability side, creditors 2 lakhs, overdraft 1 lakh. So now let us take liquid liability, that is only creditors, right? Overdraft you have to eliminate. Current liabilities means you have to take both. Okay, so what is the formula? 3 lakhs divided by 2 lakhs, that is 1.5 times. That is your current liability is 1.5 times of your current asset, sorry, liquid asset, right? Next one, what you have to calculate? Debt to equity ratio. Debt to equity ratio, that is solvency, long-term solvency ratio. You have to take what is formula? External equity divided by internal equity. Debt in external equity is nothing but debt, long-term debt, outsiders liabilities. Outsiders liabilities, you have to take all, both long-term as well as current liability. Internal equity is nothing but you have to take proprietary fund or shareholders fund or equity fund plus reserves, right? Equity shareholders fund or proprietary fund means capital plus reserves. Reserves means undistributed profit. Okay, see your balance sheet. What is your external liability? 6% debentures or long-term debt. Long-term debt is 3 lakhs. Current liability is 3 lakhs. Overdraft and credit are both the things are current liability. So external liability is totally 6 lakhs. Okay. Internal liabilities. Internal liabilities, what are the things? Equity share capital plus reserve fund or reserves and surplus. That is totally 16 lakhs. That is internal equity. So what is the formula? Debt divided by equity. Debt is 6 lakhs divided by equity is 16 lakhs. Okay, so 0.375 times. This is the formula. If you know the formula, then only you can apply, right? Solvency ratio. Solvency ratio means that is outsider liability or external equity divided by total assets. Whether your total assets are sufficient to pay for your external liabilities. External liabilities divided by total assets. External liability already we have calculated 6 lakhs divided by total assets. What is your total assets is 22 lakhs. So total assets 22 lakhs is equal to 27.27%. Next one is stock of working capital ratio. Stock of working capital, that is a working capital, we can say it is a how many times the relationship between stock and working capital. Stock divided by working capital. Working capital is what is working capital? Current assets minus current liability. That is working capital. The capital which is using for rotation of your realization of cash. That is stock has to be converted into materials, right? Purchase of materials. You have to pay for your creditors. Then that will go for your factory for finishing of your goods. That stock will be converted into sales. Sales will be converted into credit sales or cash sales. So when we are realizing the cash, that will take some time. Duration for realizing your cash, that is called working capital. For that you need some working capital. So working capital that is a total current asset is called gross working capital. Current net working capital is if you eliminate current liability, that is called net working capital. Okay, so stock divided by working capital. Stock, how much is given here? See here, stock is 5 lakhs. Working capital is current asset is 8 lakhs. 5 plus 2, 7, 8 plus current liability is 3 lakhs. So 8 lakhs minus 3 lakhs, that is 5 lakhs your working capital. So stock is 5 lakhs is equal to working capital is 5 lakhs. So 100%, right? So
hello.
Yes. Yes.
For this one, debt equity, we are considering that 0.375 as times. So now we are considering this percentage. What is the difference for that?
No, you can say as in times. If you multiply by 100, you can say it is in percentage. It is up to the thing, right? Whatever it is correct only. Okay.
Thank you.
Generally, the balance sheet or trading profit and loss account will be given. They may ask you to calculate. These are the formulas. These are the ratios, right? So you have to apply the formulas and then you have to calculate and write. See this one. You have to calculate the current ratio, quick ratio, cash ratio, net working capital. So this is the balance. Some informations are given. Current ratio, what is, if you know formula, current assets divided by current liability. Current assets, what are the current assets? You should know the items. Hello. Unmute it. Somebody. Hello. Mute it. Hello. Who is that?
இன்டர்ஃபேஸ் இருக்கும். இந்த இடத்துல ஆப்ஷன்ஸ் அப்படிங்கிறப்போ கிளிக் கொடுத்தீங்க அப்படின்னா உங்களுக்கு வந்து ரெக்கார்ட் மீட்டிங் இருக்கும். ஆனா உங்களோட பர்சனல் மெயில் ஐடி வச்சு யூஸ் பண்ணீங்கன்னா நிறைய பேர் மேக்ஸிமம் யாருக்குமே இருக்காது. நீங்க பெய்டு வெர்ஷன்ஸ் யூஸ் பண்ணீங்க அப்படின்னா முன்னாடி சொன்னீங்களா ஜி ஷூட் வந்து நீங்க பே பண்ணீங்க அப்படின்னா ஆப்ஷன் முன்னாடி யூஸ் பண்ண முடியும் அப்படின்னு சொல்லியிருந்தீங்களா?
Can you remove him like so that it will be fine?
Can you just remove him, right?
Who is the host? Can they take control of this situation? Host of the meeting?
Host of the meeting can remove that guy because it is totally disturbing.
Who is that? Somebody put some radio.
Kirbagaran is doing that.
அதை நான் சொல்றேன். நம்ம சேனலுக்கு சப்ஸ்கிரைப் பண்ணிருப்பீங்கன்னு நினைக்கிறேன். சப்ஸ்கிரைப் மீட்டிங் அப்படிங்கிற ஆப்ஷன் இல்லவே இல்லை. ஏன் அப்படின்னு பாத்தீங்கன்னா இது வந்து என்னோட பர்சனல் அக்கௌண்ட்.
Who is the host for this meeting, please? They can take the control.
இந்த மாதிரி அக்கௌண்ட்ஸ் எல்லாம் நான் ரெக்கார்ட் பண்றது அப்படின்ட்டு நான் உங்களுக்கு சொல்றேன். இதுக்கு வந்து உங்களுக்கு எக்ஸ்ட்ரா பாத்தீங்கன்னா எக்ஸ்பிரஷன்
Can somebody remove him?
software இருக்கு. அது ஸ்கிரீன்
Ma'am, please begin.
Ma'am, please continue.
Ma'am, you are on mute.
Ma'am, please unmute yourself.
Now, see this problem. So you should know what are all the items comes under current assets, what are all the items comes under current liabilities. See here, stock, sundry debtors, cash in hand and bank, bills receivable, short-term investments. These are all current assets, right? Prepaid expenses, bank overdraft, sundry creditor, bills payable, outstanding expenses. These are all current liabilities. So current assets, you total it. That is 15 lakhs. Sorry, 1,50,000. Yes, 1,50,000. Current liabilities, you add all these expenses. Sorry, all these things. 20,000, 25,000, 16, 14, 30, 50, 75. Prepaid expenses is a current asset, not a current liability. Okay. You this 1,000 rupees you have to take in this, added this, right? So quick ratio here, current ratio is 1,50,000 divided by 75,000. So 2:1, 2 times of your current asset pay for your 1 time of your current liability. That is the interpretation, right? Quick ratio, current assets. If you eliminate stock and prepaid expenses, that is called quick asset or liquid asset. 15 lakhs minus, sorry, 1,50,000, right? 1,50,000 minus stock is 36,500 and 1,000 prepaid expenses. If you eliminate, that is liquid asset. Divided by quick asset is 75,000. You eliminate bank overdraft. 20,000 you eliminate. So 55,000 quick ratio, right? Cash position ratio, cash balance, bank balance and short-term marketable securities divided by current liabilities. That's all. See this. Hello. Can you see this table?
Yes, ma'am.
Okay. See here, problem 4. Problem 3. Calculate amount of current assets and current liabilities. The problem is given only current ratio 2.5 times and working capital is 60,000. This is the problem. That's all. This is a solution. Okay. Current assets, you have to calculate current assets and current liability, but current ratio is given 2.5 times. Working capital clue, that is clue, is given 60,000. So what is the formula for current ratio? Current assets divided by current liabilities. Okay. What is current ratio formula? current assets divided by current ratio, right? What is the working capital? Working capital means current assets minus current liabilities. That is working capital. Working capital is given in your problem is 60,000. Your current asset is given 2.5 times, right? So 2.5 times of your current asset is equal to your 1 time of your current liability. So let us take current asset is X, right? So 2.5x minus 1x is equal to 60,000. So if you substitute this, take up 2.5x minus 1x, that is 1.5x. 60,000 is equivalent to 1.5x. What is x? X means one time. So 60,000 divided by 1.5. Right, 60,000 divided by 1.5, that means x 1 time is equal to 40,000 current liability. Current liability is 1 time, right? So current liability is 40,000. What is your current asset? Current asset is multiplied by 2.5 times, right? So 40,000 you multiply by 2.5 times, that is current asset is 1 lakh. So what is the current, what you have to find out? What is the value of current asset and current liability? Current asset is 1 lakh, current liability is 40,000. That's all. Sometimes ratio will be given in your problem. You have to calculate what is the value of that asset, right? That kind of problem also will be given in your
Ma'am, can you explain it one more time?
Examination point of view. This is the question is given. See here. Calculate the amount of current asset and current liability. That you have to find out. Okay. Current ratio is given 2.5 and working capital is 60,000. Right. So what is working capital? Working capital means current asset minus current liability. What is your current ratio formula? Current asset divided by current liability is equal to 2.5. Isn't it? That is given in your problem. Current ratio means current asset divided by current liability is equal to 2.5. Answer is given, right? We need to find out what is current asset, what is current liability, right? Clue is working capital 60,000 is given, right? So 2.5 current asset, let us take it as x, right? 2.5x, let us take a current liability is 1x. 2.5 times means what? Current liability will be 1, right? 2.5 by 1. Right? So 2.5x minus 1x, that is working capital 60,000 is equivalent to 1.5x. What is x? You substitute it. X take it to x is equal to 60,000 divided by 1.5. Right? So 1 time of your value is 40,000. That is current liability is 1 time. That is 40,000. What is your current asset? 2.5 times. So 40,000 into 2.5 times, that is 1 lakh. The value of current asset is 1 lakh, value of current liability is 40,000. You have to find out the value of current asset and current liability. Current asset ratio is given in your problem. Sometimes ratio will be given, you have to find out the value. Values will be given, ratio you have to find out, right? So what is given, you have to read the problem very carefully and then you have to work out. Okay. Similar way, let us see the next problem. You see the problem 4. Calculate the debtors turnover ratio and the average collection period from the following information. I already told you that is activity ratio. Activity ratio measuring the efficiency of data internal, that is debtors turnover ratio. That is what is the ability to pay off your ability to collect from your credit sales or debtors. Similarly, creditors turnover period. What is the ability to pay off your creditors? How many months or days once you can pay for them? How many days or months will take to collect from your debtors? Okay, so in this problem, what is given? Calculate the debtors turnover ratio and average collection period. Right? So total sales is given 4 lakhs. Cash sales 20% of total sales. Debtors on 1/1/2004, that is opening balance of debtors 40,000 is given. Closing debtors are given 1,20,000. So what is the formula? Debtors turnover ratio formula is credit sales, net credit sales divided by average debtors. Net credit sales divided by average debtor or closing debtor. If in your problem opening debtor as well as closing debtor, if it is given, you have to take out average. Suppose only closing is given, you take out only closing. Okay. So now you have to calculate what is the credit sales. Net credits, you have the debtor turnover ratio, you have to keep it in your mind. Credit sales by how many, what is the efficiency of collecting from your debtors, that is the ratio. Okay. So you have to eliminate cash sales. Cash sales you should not take out. Total sales is 4 lakhs. Cash sales is 20%. That is, you eliminate the cash sales. That means 4 lakhs into 80%, or 20% is 80,000 is cash sales. You deduct it. So what is your credit sales? 3 lakhs 20,000. Right? Average debtor. Average debtor is opening debtor plus closing debtor divided by 2. That is average. 40,000 plus 1,20,000 divided by 2. Average debtor is 80,000. So now you have to substitute the formula. For debtor turnover ratio is equal to net credit sales 3,20,000 divided by average debtor 80,000. That is 4 times. Debtor's turnover ratio. This is the answer. 4 times is the answer. Right? Then next one more question they have asked, average collection period. So how many days or months will take to collect from your debtor? Simply you can apply the formula, number of days or months in the year divided by debtor's turnover ratio. Number of days, you can let us assume 365 days or 12 months divided by 4 times. So if you calculate this, 91 days or 3 months is your debtor's collection period or average collection period. One more thing you have to keep it in your mind. Suppose bills receivables also given in this problem. Bills receivable as well as debtors you have to add. Both the things are called accounts receivable. Right? Accounts receivable, it includes debtors plus bills receivable. Okay. Both the item you have to add. Right? Similarly, creditors, see problem number 5, creditors turnover ratio. How to calculate creditors turnover ratio? Formula is, what is the formula? Creditors turnover ratio is equal to net credit purchases. Why I am saying net? Net means suppose return, purchases return, if it is there, you have to deduct the returns from your purchases. Similarly, here in this problem, total sales 4 lakhs is given. Sales return 20,000 is given. You have to deduct it. That is why net credit sales. Okay. So first you have to deduct the returns minus cash sales. You have to take only the credit sales. Okay. See here now. What is the formula? Creditors turnover ratio is equal to net credit purchases divided by average creditor or average accounts payable. Or average if it is not given, opening and closing is not given, you can take it only closing creditors. Okay. So let us see what is given. Credit purchases during the year 2005, 12 lakhs. Creditors plus bills payable. Suppose creditor given 3 lakhs. Bills payable is given 1 lakh. You have to take totally 4 lakhs. Creditors, closing creditor, here it is given 1 lakh. Bills payable is given 1 lakh. So totally you have to take 2 lakhs. Both creditors as well as bills payable called as accounts payable. Okay. So let us solve this. Average creditor is opening plus closing creditor divided by 2. So opening 4 lakhs divided by closing, plus 2, closing 2 lakhs. Totally 6 lakhs divided by 2. That is average creditor is 3 lakhs. Now use apply this formula. Creditors turnover ratio is credit purchases. Here no informations are available. Cash purchases are not available. Purchases returns are not available. If it is there, you have to deduct it, eliminate it. Right? So net credit purchases, let us assume total purchases as credit purchases 12 lakhs divided by average creditors, that is 3 lakhs, 4 times. Next you have to calculate average collection period. Similarly, you have to calculate number of days or months in the year divided by creditors turnover ratio. 365 days or 12 months divided by, answer is 4 times. So your answer is 91 days or 3 months. Period is the data creditors payment period. Okay. So next one, similarly, stock turnover ratio. stock turnover ratio. What is the formula? Net sales or cost of goods sold divided by average stock, right? Average stock. So stock turnover, the relationship between stock as well as turnover means sales, inventory, right? So sales net, in this case you should take both these cash sales as well as credit sales. You should not take only credit sales. You have to take up both cash sales as well as credit sales. Either you can take up the sales value, or usually stock we used to in your financial statements we have to show only the cost value of the stock, not the profit value. Profit you should not add. So mostly we used to take cost of goods sold. Cost of goods sold divided by average stock. So in this case, net sales is 80,000. See problem, opening stock 18,000, wages 14,000, closing stock 22,000, sales 80,000, purchases 46,000, carriage inwards 4,000. So what is here? Sales is 80,000. Okay. Opening stock 18,000, closing stock 22,000. So average stock 18,000 plus 22,000 divided by 2. So average stock is 20,000, right? If you take sales, net sales divided by average stock means 80,000 divided by 20,000, that is 4 times. If you take up cost of goods sold, cost of goods sold means what? You have to eliminate the profit. So what is clue is given? Purchases plus expenditure. If you take this total, that is cost of goods sold. 46,000 plus wages 14,000. 60 carriage inwards 64,000 is the cost of goods sold. Okay. It is not worked out here. If you take up cost of goods sold means here 64,000 divided by 20,000. Cost of goods sold is equal to opening stock plus purchases plus expenses minus closing stock. So here purchases 46,000 plus opening stock 18,000 plus expenses 14,000 plus carriage inwards, totally 18,000 minus closing stock 22,000. So how much comes? 46 plus 18 plus 18.
60,000.
20, 36, 76, 82. 82 minus 22. 60,000. Right? 60,000 is cost of goods sold. So 60,000 divided by average stock 20,000. So answer is 3 times. Some problems they may assume sales may be taken, and generally stock turnover ratio we have to take cost of goods sold. That is the correct method. Okay, this is the correct method. See next one. From the following information, calculate stock turnover ratio. Stock turnover ratio you have to see here. Sales is given 4 lakhs. Gross profit ratio is given 10% on sales. Opening stock 38,000, closing stock 41,500. So in this case, we have to take cost of sales or cost of sales. So cost of sales is 4 lakhs minus 10% gross profit 40,000. If you take cost of goods sold, that is 3,60,000. If you take sales, that is 4 lakhs divided by average inventory is 38,500 plus 41,500 divided by 2, that is 40,000. If you take, say, on sales means 4 lakhs divided by 40,000. If you take cost of goods sold, 3,60,000 divided by 40,000, 9 times. Generally, stock turnover ratio, we used to take cost of goods sold. That is to be taken. Okay. Then this one is also like the same. Debtors turnover, creditors turnover, stock turnover. You practice it, this problem. Okay, let us see some other type. See this problem. Informations are given. You are required to calculate total assets turnover, fixed assets turnover, and working capital turnover ratio. Only these turnover ratios you have to. Turnover means, that is, you have to take out sales, right? Turnover means sales. You have to take up. Okay. So the assets turnover means the relationship between assets value and sales. Fixed assets turnover means the relationship between fixed assets and sales. In working capital turnover means working capital and sales. Okay. So total assets turnover ratio, what is the formula? Net sales divided by total assets. In this case, sales means you have to take both cash sales as well as credit sales. In case of debtors turnover ratio, you have to take only credit sales. Right? You have to keep it in your mind, all these things. So first let us see one by one. Total assets turnover. Assets turnover means net sales divided by total assets. What is your sales? Sales, how much is given in your problem? Sales for the year 30 lakhs are given. See here, 30 lakhs, sorry. 30 lakhs are given here. And then total assets. Total assets, you total it. Plant and machinery, land and building, motor car, furniture, stock, debtors, bank, cash. These items all are total assets. So how much it comes totally? Total it. 13, 15, 16, 17, 18, 18, 90, 19, 70, 18 lakhs.
19 lakhs.
18, 90. How much comes? Totally?
20 lakhs is coming, madam. All adding 20 lakhs.
20 lakhs. Okay, good. 20 lakhs. So now you have to calculate net sales divided by total assets. That is, net sales 30 lakhs divided by 20 lakhs. 1.5 times. Fixed assets turnover ratio. You have to take out only fixed assets. Net sales divided by fixed assets. Net sales 30 lakhs. Fixed assets. What are the fixed assets? Land and machinery, land and building, motor car, furniture. Only these 4 items are fixed assets. Stock, debtor, bank, cash. These 4 items are current assets. Okay. So how much it comes?
16 lakhs.
16 lakhs.
16.
So 1.88 times. Working capital turnover ratio. Say net sales divided by net working capital. Working capital, I already explained you. Total current assets minus total current liability is called working capital. Net sales is 30 lakhs divided by your current assets. You total these 4 items. 1 lakh 80, 1 lakh 10, 80,000 plus 30. So how much it comes? 370, 4 lakhs.
4 lakhs.
4 lakhs. Current liability is 1 lakh, 2 lakhs. Outstanding also you add it. So how much comes? 2 lakhs, right? So how much comes? 4 lakhs minus 2 lakhs. Your working capital is 2 lakhs. So 30 lakhs divided by 30 lakhs divided by 2 lakhs, that is 15 times. That's all. This is the solution. Okay. Similar way, this is you are required to calculate gross profit ratio, net profit ratio, operating ratio, and operating profit ratio. If they give statement or information, you are required to calculate these ratios. You should know the formula. Simply you apply the formula, that is enough, right? Gross profit ratio, that means what? Gross profit divided by gross profit we used to calculate on what? Sales. right? So gross profit divided by sales, that is gross profit ratio. Net profit ratio means net profit divided by sales, that is net profit ratio. Operating ratio means operating expenses. Operating expenses divided by sales into 100, that is operating ratio. Operating expenses, that means only the expenses which we are incurring for the business, that is for profit and trading, profit and loss account expenditure. That is non-trading or non-cash expenditure should be eliminated from operating expenses. What are all non-operating or non-cash expenditure? That is depreciation you should eliminate, that is not a cash expenditure, right? Loss on sale of machinery, that is non-trading expenditure. Okay. Then payment of commission for some other purposes, that is not for this business. Instead of business, if you are doing some other thing, that is you are paying interest for your personal use, like that, right? So that all the things should be eliminated. That is called operating. Operating means only the expenditure which are incurring for the business, for your business, that is called operating expenses. Operating profit means if you sales minus operating expenses, that is called operating profit, right? See this here: sales, other incomes, cost of goods sold, employee benefit cost, finance cost, other expenses. Only these informations are given. Let us calculate gross profit ratio. Gross profit divided by net sales into 100. What is your gross profit? That is sales minus cost of goods sold, that is called gross profit, right? Cost of goods sales is 8 lakhs. Cost of goods sold is 3,50,000. Sorry. 8 lakhs, 3,50,000. So gross profit is how much? 6,50,000. Sorry, 4,50,000, right?
Yes, 4
lakhs 50,000 divided by 8 lakhs. Gross profit divided by sales into 100, that is 56.25%. Similarly, net profit ratio. Net profit divided by net sales into 100. Net profit is, what is net profit? Gross profit minus that expenses. That is, what are the expenses? You can say sales minus cost of goods sold, that is called gross profit. Okay. Net profit, you have to add other income and eliminate all the expenditure. See here, sales is 8 lakhs. Other income is also given 50,000. So totally 8 lakhs 50,000 minus cost of goods sold is 3,50,000, and then employee benefit cost, that is other expenditure, 1,20,000 you have to eliminate. Finance cost, that is interest payment, that thing also you have to eliminate, that is 30,000 for calculation of net profit, right? Other expenditure 50,000. All the expenditures you have to eliminate, all the income, other income also you have to add for net profit. So net profit is how much it comes, that is net profit is 33 lakhs, right? 8 lakhs plus 50,000 minus 3,50,000 minus 1,20,000 minus 30,000 and 50,000. If you calculate these things, you will get 3 lakhs, right? Net profit 3 lakhs divided by 8 lakhs into 100, that is 37.5%. Operating ratio, that is operating expenses. You have to take only cost of goods sold plus operating expenses divided by net sales. So in this case, cost of goods sold is 3,50,000. What is operating expenses in this case? Operating expenses is employee benefit cost is employees working in your business, right? So you are spending expenses on that. So that is operating expenses. 1,20,000 you have to add it. Then other expenditure you have to take up. Finance expenditure you have to exclude, because finance expenditure means interest on payment of your loan. That is not related to your expenditure related to your business, trading business or manufacturing business, right? That you should not add it. So only cost of goods sold plus expenses which is relevant to your business. So how much it comes totally? 4,73,000, 5,20,000 divided by 8 lakhs. So a 65%. Operating profit ratio, it is very easy. Operating sales minus operating expenses. Operating profit means eliminate this total cost is how much? 350, 120, 50,000. 4 lakhs 70, 5 lakhs 20,000. 8 lakhs minus 5 lakhs 20,000. That is operating profit is 2 lakhs 80,000, right? 2 lakhs 80,000 divided by 8 lakhs. That is 35%. Operating profit ratio. Operating profit are earnings before interest and tax. Earnings before interest and tax are the same, right? See here, this is the important problem based for your examination point of view. See, ratios are given, some clues are given. You are required to prepare balance sheet. See here, Future Retail Limited provides the following information. You are required to prepare a summarized balance sheet as on 31/3. So what are the informations are available? We have to extract the value of the assets, right? What are the things are given? Working capital, bank overdraft, fixed assets to proprietary fund ratio are given, resource and surplus are given, current ratio, liquidity ratio. So first let us calculate what is the value of current asset, current liability, stock with the help of current ratio, liquid ratio and working capital, right? See, current ratio is 2.5 times, current asset is 1 time, right? What is working capital? Current asset minus current liability is the working capital. Working capital is 2,40,000 is equal to current asset is 2.5x minus current liability is 1x. Okay, so 2.5x minus 1x means 1.5. 2,40,000 is equivalent to 1.5x. What is 1? 1 x is equal to 2,40,000 divided by 1.5, that is 1,60,000. That means your current liability is 1,60,000. What is your current asset? 1,60,000 multiplied by 2.5. That is your current asset. That is 4 lakhs. Now we have to find out what is the value of current asset, what is the value of current liability, right? Then next one, stock. See here, liquid ratio 1.5. What is the difference between liquid and asset and current asset? Difference is stock, right? So if you take up 2.5 times is the current asset, liquid asset is 1.5. That means stock value is equivalent to 1 time. That is 1 time is equal to, that is 1,60,000, right? Liquid ratio is what? Current, in this case, bank overdraft is also given 40,000. Let us assume here this liquid ratio is given on current liability. That is, current liability means current assets, liquid asset divided by current liability, 1.5 times. So in this case, current asset and liquid asset, 1 time is the difference, that is called stock. Stock is 1,60,000, right? Fixed assets and shareholders fund. Here, see here, fixed assets is equal, fixed assets to proprietary fund ratio. It's a 0.75 times. There is no other clue is given. Fixed assets, if you know either fixed assets or proprietary fund means what? Capital plus resource and surplus. That is called proprietary fund or equity fund, right? Or capital employed. We can say it is a capital employed, right? So fixed assets we do not know. Proprietary fund ratio we do not know. Then how to find out? So we have to apply our accounting equation. What is our accounting equation? All the equity fund plus liabilities, long-term liability plus current liability are equivalent to total assets, right? That is the accounting equation. Let us solve this equation. See here, shareholders funds plus current liabilities is equal to fixed assets plus current assets, right? So fixed assets to proprietary ratio is given 0.75, right? That means if your fixed asset is 0.75 time, that means equivalent to your proprietary fund will be 1 time, right? Let us assume fixed asset no, so shareholders fund, let us take it as X, right? 1 time is X. Proprietary fund is X, 1 time, 0.75 X. Let us see solve this equation. Shareholders fund is 1x, okay, plus current liability we know already, we have calculated 1,60,000 is equivalent to what is your fixed asset 0.75x plus what is your current asset? Current asset is 4 lakhs. We have calculated here. So 4 lakhs. Now we solve this equation. Bring x into one side and value into another side. 1x minus 0.75x is equal to 0.25x. Here 4 lakhs, if you bring 1,60,000 this side, it will become minus. So 4 lakhs minus 1,60,000, the value is 2,40,000. What is 1x? 0.25x is equal to 2,40,000. What is 1x? 1x is equal to 2,40,000 divided by 0.25. Therefore, x is equal to 9,60,000, right? 9,60,000 is 1 time, right? That is called shareholders fund. Shareholder fund is 9,60,000. What is your fixed assets? 0.75x. So 9,60,000 into 0.75, that is 7,20,000 is the fixed asset. So now we have find out fixed asset, shareholders fund. Now one more thing you have to calculate. Resource and surplus is 1,60,000. So share proprietary fund or shareholder fund is 9,60,000. Minus 1,60,000 is resource and surplus. What is the capital? Capital will be 9,60,000 minus 1,60,000, that is 8 lakhs. Capital will be 8 lakhs. Now we have find out all the things. Let us prepare balance sheet. This is the balance sheet you have to prepare. Asset side, that is fixed assets. See here, fixed assets is 7,20,000. Current asset, you have to write one by one. Stock, you have calculated 1,60,000. Here you have calculated 1,60,000. Out of 4 lakhs, 1,60,000 is stock. So you can write other assets, other current assets. This 1,60,000 total current asset is 4 lakhs. Mind deducted, the rest of the asset is 2,40,000 other current asset, right? Come to the liability side. Share capital 8 lakhs. 8 lakhs, how you have calculated? Here, shareholders fund. Shareholders fund is equal to capital plus reserves and surplus. Reserves and surplus, right? So now here we do not know what is capital. So shareholder fund is 9,60,000 we have calculated minus resource is 1,60,000. Therefore capital is equal to 8 lakhs. Okay. So share capital 8 lakhs, resource and surplus 1,60,000. So total these things are called shareholder fund or equity fund. Okay. Then current liabilities totally it is 4 lakhs. Out of 4 lakhs, the information clue is given in your problem. Bank overdraft is 40,000. So 40,000 you eliminate it here. That is bank overdraft 40,000 minus current liability is how much? 2 lakhs. 1,60,000. Current liability is 1,60,000 minus 40,000. So other current asset is 1,20,000. Right? But this is the answer. Balance sheet is the answer. These are the things are workings as well as part of your answer. Okay. This kind of problem definitely will be given for 10 marks question. So if it is a small one, if it is given in 6 mark question, they may ask. Okay. Do you understand this? Hello. Do you understand this? One more time. Do you want to explain?
Yes, madam.
One more time.
Okay. One more time I explain. See here, this is the problem. What is given, you have to read carefully. What is the clue? Information is available. So what you have to prepare? In this problem, current ratio, liquid ratio, working capital, these are the clues are given. You are required to prepare balance sheet. That is the question. Okay, you have to prepare balance sheet. Right? These are all workings. How to calculate this? This is the answer. Balance sheet we need to prepare. For that, the value of these assets and liabilities value we need to find out, right? So first you have to, what is the clue? With the available of current ratio and working capital, we can find out current liabilities and current assets value. 2.5 times. Current ratio is current asset divided by current liability is equal to 2.5. That means what? Your current asset is 2.5 times or equivalent to 1 time of your current liability, right? If your current liability is 1 rupee, your current asset will be 2.5 rupee. Do you understand? So let us have this working capital 2,40,000 is what? Current asset minus current liability is the working capital. Current asset is 2.5 times minus current liability is 1 time. So 1.5 times is equal to 2,40,000. Okay. Working capital is 2,40,000 is equivalent to 1.5 times of 1.5x. Okay. So what is 1 time? 1 time of your x. X is equal to 2,40,000 divided by 1.5. That means 1,60,000. Your current liability is 1,60,000. Your current asset is 1,60,000 into 2.5 times. Your current liability, if it is 1,60,000, what would be your current asset? Multiplied by 2.5 times. That is 4 lakhs. Okay. So now you can utilize your liquid ratio. Your liquid ratio, we are assuming you can write either you can take liquid formula, liquid asset by liquid liability or current liability. We are assuming here current liability. Suppose if you are assuming here as a liquid liability instead of current liability, let us calculate liquid liability. Suppose if you are taking up liquid liability means how much it will be liquid, your bank overdraft should be eliminated, right? Your current liability is 1,60,000. Your liquid liability, how much it is? 40,000 deducted. 1,60,000 minus 40,000. So 1,20,000 it will be, right? So 1,20,000. 1.5. Wait. Current asset is 4 lakhs minus stock. Okay. Stock value is how much? That we have to find out. Okay. Current liability, let us take it as 1,20,000. Okay. 1.5. If you solve this equation, how much it comes? $1.2 into 1.5, how much? 1,20,000 into 1.5. 1,80,000, right?
Yes, ma'am.
So here 1,20,000, 2,20,000, right? If you are taking even you can take either liquid liability or current liability, but you have to write assumption, right? What you have taken. Both the things are correct. Okay. So if you are treating it as a liquid liability, liquid ratio is equal to liquid asset divided by liquid liability. Liquid asset means current asset minus stock, that is 4 lakhs minus stock. Stock we do not know, we have to find out. Liquid liability is current liability minus bank overdraft 40,000. If you eliminate, that is liquid liability is 1,20,000. So 1,20,000 into 1.5 is 1,80,000. Therefore, stock is 2,20,000, right? So in that case, how you have to solve here? Answer will be different. Okay. Here is the same. On 1 lakh current liability, you have to take 1,60,000. Here current liability is 4 lakhs. Both the things are same. Here it will be is okay. This answer is same. But here you have to write stock 2,20,000. 2,20,000 stock. Here totally 4 lakhs. So 1,80,000.
80,000.
Other current asset is 1,80,000. Totally it will be 4 lakhs. Only here you can make the difference. That's all. Okay. Only the stock value will differ. The remaining things are same. Right? Anything you can assume. Either liquid asset, liquid liability you can take, or current liability also you can take, no problem. But you have to write one note. Here you write one note. I assumed. Formula. Liquid ratio is taken as liquid asset divided by liquid liability. Liquid ratio is assumed to be taken as, okay, liquid ratio is assumed to be taken as liquid asset divided by liquid liability. Or if you are taking current liability, you have to write here current liability. Here you have to take 1,60,000. Okay. Anyway, you can do. This is a correct one, right? Can we go for next one?
Okay, ma'am. Okay, ma'am.
Okay. See this problem. So many things are given. You are required to prepare balance sheet. This is the balance sheet is the answer. You are required to calculate so many things. So let us see this problem. Oh, already time up. 3 o'clock. The other person will be waiting to take up the class. Okay, just small things I explain you here. Paid up capital, plant and machinery, everything is given. Sales is given 20%. Gross profit is given 25%. Your total sales are given 5 lakhs. This is the clue, first clue, right? First clue is 5 lakhs. You calculate sales return is there. Yes, sales return. See here, annual credit sales 80% of your net sales. Total sales is 5 lakhs is given. Annual credit sales 80%. Gross profit is given 25%. Then sales return, how we have? See here, sales return is given in your problem, 20% of your sales. First you have to eliminate the sales return. Net sales is required, right? So net sales is 20% means 5 lakhs into 20%, eliminate 1 lakh sales return. Net sales is 4 lakhs. So net credit sales is 80% is the net credit sales. This 4 lakhs into 80% is credit sales, 3,20,000. Gross profit you have to calculate on total net credit sales, not credit sales, no net sales. Net sales 4 lakhs into 25%, that is profit, gross profit. Net profit also you can find out. Based on this, we can find out what is the cost of goods sold. Then inventory you can calculate. Then with the help of receivables turnover ratio, we can find out what is the debtor, what is the creditor. All these things you can find out with one clue. Another clue you can easily find out. Then you have to prepare all the items and prepare balance sheet. Okay, you practice this. If you have any doubt, we will see in the next class this one. Okay. Okay, I think we can wind up. Other person is waiting. Okay, practice some problems. You see your question bank in our website. Download it and practice this kind of problems. If you have any doubts, you note it down. At the end of the last class, we will discuss. Okay. Bye.
Thank you, ma'am.
Thank you, ma'am. Thank you, ma'am. Thanks a lot, ma'am.
Okay.
Thank you, ma'am.
So good evening to all of you. Am I audible? Actually, yes, madam has to close the slide.
Yes, sir, you are audible.
Yeah, fine, thank you. Madam, can you close the presentation? Okay, she has closed it. So let me share the slide for today's presentation. So please confirm whether the slide is visible to everyone.
Yes, sir.
Yes, sir. Okay, fine. Thank you. Thank you. So in the past week, we have been discussing about the basics of managerial economics. In the lesson, we have studied what is the need for studying economics, what is managerial economics, what is the nature of managerial economics, and the circular flow of economic activity between different agents, and what are the objectives of the firm in which a manager can take some business decision. The next part is demand analysis. In that we have been discussing on law of demand, determinants of demand, what are the different types of demand. There are some exceptional demand curves which slopes upwards instead of sloping downwards. And what is the concept of elasticity of demand, and what are the different types? There is price elasticity, then income elasticity, cross elasticity, then how demand is being forecasted. Then in the subsequent lesson, we have discussed about the basics of supply analysis, in which law of supply, the determinants of supply, elasticity of supply, and factors influencing supply have been discussed. So now coming to the today's lecture. So today we will be discussing about the production analysis. So once you understand the demand and supply, the next thing to get learned is on production. So this unit will help you to understand what you understand by production, how it is organized through integrating different factors of production like land, labor, capital, and organization. Then how managers will procure the right combination of these factors, considering some like diminishing marginal utility economics, so that they can get better profit. Ultimately, the aim is to maximize the output with minimum cost. So in this lesson, we will be discussing on these aspects. So these are the outline which will be discussed in today's class. First, we will have a discussion on factors of production. Then what do you understand by production function? Then we have a very popular production function, which is known as Cobb-Douglas production function. Then law of diminishing returns. Then law of returns to scale, followed by isoquant curve and expansion. So this is the one part of the lecture which I will be dealing today. So to start with, let us have some idea about the factors of production, that is inputs. Okay. So before that, what do you understand by production? In economic parlance, production means creation of utility to satisfy human wants and needs. For example, producing a pen or producing some food grain. So this is an example for production. So how this production is achieved? Production is achieved through integrating some factors of production, that is inputs. Generally in economics, we classify the inputs under four groups, that is land, labor, capital and organization. So these are the resource inputs which are used to produce certain goods and services that will help the economy to achieve more towards a higher level. So in among the four inputs, land is a heterogeneous and its supply is fixed. That is you cannot increase the supply of the land. Whatever the area, it is fixed. You cannot change it. So it means that it is a permanent factor of production. But the one thing is, land is productive only when some other factors are getting integrated with it. For example, with the application of capital and labor, you can realize the productivity of land. So the next factor of production is labor. So labor, here if you see, the supply of labor is inelastic. So which means that when the price of labor is increasing, there won't be much difference in the supply. But it differs in productivity and efficiency because of the nature of skill and what you call the area in which their expertise. The next one is capital. Capital, basically it is a man-made factor and it is highly mobile. Unlike labor, the supply of capital is elastic. So that is, if there is a small change in the demand, obviously the supply will be, there will be huge change in the supply. Then the next one is the organization. Organization, basically it is an entity which helps to plan, supervise and organize the whole business activity, and it also assumes some risk, so that through assuming risk, the organization aims to achieve better profit. But please keep in mind that there are four factors of production: land, labor, capital and organization. In some textbooks they used to give, instead of organization, management or entrepreneurship. Okay, so all these are synonymous. So once you know what is production and what are the factors of production, next you have to understand what is production function. So basically, production function shows the relationship between input and output. So this production function will indicate the amount of commodity that can be produced from various combination of input factors. So input factors already we discussed: land, labor, capital and organization. So through production function, one can decide the maximum level of output that can be produced from a given level of input. So when I say a decision on producing the maximum output with a given level of input, so this also can be called as technical efficiency. Okay, this may not be present in your study material. So by technical efficiency, you mean that the capacity to produce the maximum possible output with the given level of resources. Okay, so maybe in a group of firm, one firm may be achieving the potential level. Okay, another firm may be achieving a bit lesser than the potential level. Then the difference is due to technical inefficiency. Okay, so this you have to understand. Then it also helps to decide how much minimum input can be used to get the desired level of output. So when you say about production function, you can see in this slide that Q is the output. Output is a function of land, labor, capital and organization. So that also can be denoted like X1, X2, X3 and X4, where X1 is land, X2 is labor, X3 is capital and X4 is organization. So the purpose of business manager is to identify the right combination of inputs so that he or she can aim for producing the desired level of output. So basically, a production function is a technical relationship showing, it shows the relationship between output and inputs. Okay, there may be multiple output also, because for example, I would say when you apply inputs like fertilizer seed, then plant protection chemical. So you get some commodity. For example, in agriculture, if you apply fertilizer, plant protection chemical, irrigation, seed, you get some rice or wheat. So apart from this grain, you also get some straw. So in that case, there is a main product and there is a byproduct. So in this case, there are two outputs. Okay. So don't think that the production function means a relationship between only one output and multiple inputs. Not like that. There may be multiple outputs also. So there are a lot of production function. For example, we have the quadratic production function. Then we have corporate class production function, which is widely used. Then we have transcendental production function and translog. A lot of production functions are available in the use, but the most widely used production function is corporate class, which is being particularly which is being widely used in agriculture. So initially, this production function is given by two persons, Cobb and Douglas. They propose the production function with only two inputs, that is capital denoted by K and labor denoted by K. So this is what given in this slide. So let me show in the. So this is the Cobb-Douglas production function. So if you estimate, obviously you have to estimate some parameters like Q, there is output, is a function of capital and labor. The coefficient, that is beta 1. Beta 1 is associated with the capital and beta 2 is associated with the labor. So this beta 1 and beta 2 are also known as elasticity coefficients or production elasticities. It gives an idea that when there is a change in capital, how much output we can see whether there is any increase or decrease in the output. For example, if beta 1 is 0.10, it means that 1 percentage increase in the capital, it leads to that is 0.10, that is 0.1% increase in the output. Okay, so this is the interpretation. Then this alpha is known as the intercept. Okay, for example, I will give an example from agriculture. So I am hearing some noise from the participant. Please mute yourself so that whatever I talk, you can hear properly. So please mute yourself. Who are not in the online meeting, so please mute yourself. For example, if you take agriculture, when fertilizer is applied, probably you may get a better yield. Suppose if fertilizer is not applied, still you also get some yield. Okay. That is captured by alpha. So please mute yourself. I am hearing some disturbance from the participant side. Please mute yourself. So when we talk about production function, we have two types of production function. One is short-run production function and another one is long-run production function. The short-run production function has some inputs which are, some inputs are fixed, okay, but whereas in the long run, there is no fixed input. Every input is variable. So now moving to the next part of the production function, there are some different concepts used in explaining the production function.
Mute the.
Excuse me, host only should mute.
Yes.
I don't know who is. Mr. Prakash, can you mute yourself? Mr. Prakash, can you mute yourself? I request the host to mute Prakash. Okay, let me continue the presentation. So first, let us discuss about the total production, that is denoted by TP. So what do you mean by total production? That is the maximum level of output. That is, output is denoted by Q that can be produced with a given amount of input. So it's a very straight explanation. Total output produced with the given amount of input, that is called as total production. So the next we have average production. So average production is output produced per unit of input, which is denoted by AP, that is the ratio between Q and L. L means, maybe we can take L is a labor. Okay, so how much output is produced per unit of labor. Then we have marginal production, which is denoted by MP. So when you say marginal production, it is a ratio between change in total output, that is delta Q. So in economics, if you see any symbol like a triangle, it is called as delta. Okay, delta means change. So change in the total output, that is denoted by delta Q, divided by change in the 1 unit of input, that is delta X. So input may be any variable, it may be labor or it may be capital. Okay, so in case of labor, then it is called as marginal production of labor. In that case, it is delta Q divided by delta L. Then we have marginal production of capital. In that case, it is delta Q divided by delta K. Okay, so this is a very simple. Once you understand the three concepts, that is total production, average production, and marginal production, then in the subsequent slide, I will show the 3 stages of production, which will be helpful for any business manager to take decision on production. So at which stage a firm should produce, if at all they want to be in the profits. So this slide shows the production schedule. So this can be explained through a popular law known as law of diminishing returns. So this law states that if increasing quantity of a variable input, in this case labor is given as an example, that is if increasing quantity of a variable input is combined with the fixed input. So generally fixed input we take land, because land is already, we discussed that land is a fixed end supply. So when labor is combined with their fixed input, eventually the marginal product and average product will decline. So this is what shown in the chart on the right side of the slide. So if you see the this table, which is called as production schedule, the first column shows the number of unit of labor. That is this is a variable input. It is combined with a fixed input. Okay. Now the total production, when one labor is used, the total product is 20 units. Obviously, the average product will be 20. That is 20 divided by 1. That is 20. The marginal product, of course, at initial level, it will be. Then when the labor increases by 1 more unit, that is from 1 to 2, the total product gets increased from 22 to 54. This is a hypothetical data for your understanding. Okay, so obviously your average product will be 54 divided by 2, it is 27. In the marginal product, I already told that marginal product is change in the total product divided by change in the input. So in this case, change in total product is 54 minus 20. 54 minus 20 is 34 divided by 2 minus 1. 2 minus 1 is 1. So obviously you will be getting I request the participants to mute yourself, or please the host should do this.
Yeah, Prakash Rock, can you please unmute yourself, or host, can you remove him?
Yeah, since I don't have access as a host.
Yeah. Host, can you please remove Prakash Rock? Like, he keep on unmuting, like it is creating a trouble for all of us, right?
So I will call the host.
It is affecting 135 members. Even the host can give you access.
Actually, online disturbance இருக்கு. பிரகாஷ் பேசிட்டே இருக்காரு. Host
போட்டுக்கிறாங்க தங்கச்சி இந்த மாதிரி இல்லை.
Okay, let us continue. So I requested the host to mute Mr. Prakash. So please confirm that the slide is visible.
It's visible.
Yes, okay. Okay, thank you. Okay.
Prakash, let's mute your audio. Prakash.
So to continue the discussion,
once again how you calculate.
Yeah, I will explain. So we have been discussing about the law of diminishing returns. So in that, if you see this table, which is known as the production schedule, the first column shows the labor, that is the variable input. It keeps on changing when it gets, interacted with the fixed input like land, we get some product. Okay. So for this TP, that is the total product. So at 1 unit of labor, the total product is 20. So obviously the average product, that is AP, is 20. That is 20 divided by 1. So in this case, since it is the first unit, so obviously marginal product will be 0. So when the labor unit increases from 1 to 2, then the total product gets increased from 20 to 54. So in this case, the average product will be 54 divided by 2. It is 27. Okay. So now the next is marginal product. So the marginal product is, as I already told, change in output due to change in input. So here the change in output is 54 minus 20. So 54 minus 20 is 34 divided by change in input. So the change in input is 2 minus 1. That is only 1 unit change. So obviously 34 divided by 1 will be 34 only. So that is what given here. So subsequently, when the labor is increased by 1 more unit, that is from 2 to 3, the total product gets increased to 81, and then the average product will be 81 divided by 3, that is 27, and again the marginal product is 81 minus 54 divided by 3 minus 2. Okay, in this case the denominator will be 1 because we are increasing the labor by 1 unit at every level. So this is how you are deriving the production schedule. So this data, if you are presenting in the graphical form, it looks, like the chart which is shown in the right side. So at 1 unit of labor, the horizontal axis shows the labor, the vertical axis shows the product, that is total product, average product, and margin product. So if you see the total product increases till some point, and then it becomes constant, and then it starts declining. If you see the average product auto, it increases till some point, and then it starts to decline. Similarly, the margin product also starts increasing up to certain point. After that, it starts declining. At one stage, it becomes 0, and then it turns negative also. Okay. So this I will be discussing as 3 stages of production function in the subsequent slide to get better clarity. So before that, I would like to explain one more law, that is law of returns to scale. So this law of returns to scale, basically it applies only in the long run, because in the long run, all factors are variable because we have sufficient time to change the inputs. So by increasing the input, you may get some combination of returns in an organization. Okay, that the combination may be in your favor, or it may not be in your favor. So that is called as returns to scale. That is change in percentage output resulting from a percentage change in all the factors of production. So because in long run, all the factors of production are variable. So under returns to scale, we have 3 types. One is increasing returns to scale. Next one is constant returns to scale. Third one is diminishing or decreasing returns to scale. The first one is increasing returns to scale. In this case, what happens? the output of the firm increases more than in a proportionate to an increasing output. For example, output increases by 20%, whereas all the inputs increases by 15%. So in this case, it is increasing returns to scale. The next one is constant returns to scale. In this case, 10% change in the inputs leading to 10% change in the output. So here the proportion is same. So then it is known as constant returns to scale. The next one is, of course, you can easily guess it, diminishing or decreasing returns to scale. In this case, what happens? The output increases in a smaller proportion in comparison to the increasing input. That is, input increases by maybe 10%, but whereas output increases by only 8%. So in that case, you can call it as diminishing returns to scale. So all this happens in an organization. We already discussed what is an organization. That is, it is an entity that plans, supervises, organizes all the activity, and it controls the business also. And sometimes it also takes some risk so that it aims to achieve the desired level of profit. So once you understand the law of diminishing returns, which is applicable in the short run, and the next one is the law of returns to scale, which is applicable in the long run, so that you can take some business-oriented decisions. Now coming to the 3 stages of production function, which is being explained with the 3 curves, which was discussed in the previous slides. That is, this one shows the top panel shows the total product curve. That is, as you increase the input combination with the fixed input like land, the output initially increases at increasing rate, then it increases at constant rate, then it increases at decreasing rate, and finally it decreases at increasing rate. Okay, there will be 3 stages. You can see the witness. So further, how to classify the stages, that you can do with the help of the average product curve and marginal product curve. So the bottom panel shows the average product curve and the marginal product curve. So here, if you see, both the curves are having inverted U shape, but if you see the difference between average product curve and marginal product curve, the marginal product curve goes negative, okay, but whereas average product curve will not go to negative, because average product is total output divided by input used. So obviously it cannot be negative. But marginal product can be negative, because marginal product is change in output divided by change in input level. So it can be negative when the output declines. So the first stage is up to the interaction, that is the coincidence between average product curve and the marginal product curve. So this point, that is point B. Up to point B, it is called as stage 1. So in stage 1, the firm will be functioning suboptimal. Okay, suboptimal means it is not utilizing its full capacity. Then the next stage is that is stage 2. That is stage 2 spans from B to C. So this is the optimal region. So optimal region means wherever the firm decides its production level, it will be having some profit. Okay, but the best profit is, of course, you have to do some analysis. Then the next stage is negative. That is the stage 3. That is from point C onwards. So from point C, it is called as superoptimal. That is, this is a stage wherein you get negative returns. Here, it is also known as double loss zone. Double loss zone, because your total product also declines, and second, your marginal productivity also is negative. That is on this chart also you can classify based on the elasticity of production, because earlier we discussed about the elasticity, that is the response of demand or supply to change in the price. So similarly, elasticity of production is response of production due to change in the combination of input. So in this case, in the stage 1, the elasticity, here you define elasticity as the ratio between marginal product and average product. Okay, so marginal product divided by average product, that gives the elasticity of production. So this you keep in mind. Probably this may not be available in the study material. So in stage 1 you will be having elasticity more than 1 because MP is higher than AP, average product. So obviously elasticity of production will be more than 1. In stage 2, the elasticity of production will range from 0 to 1. Okay. Whereas in stage 3, what happens? Elasticity of production will be negative. So this elasticity of production will help the business manager to take some business-oriented decision. So obviously, as I already told that the stage 2 is the optimal zone. So if you are a manager, you have to decide your production level somewhere in stage 2. Now coming to the next part of today's lecture, ISOQuant. So ISOQuant, again, it is a curve that is considered the bottom panel, left panel. So this is the curve which is showing 100. Okay. So this is called as ISOQuant. That is, it is a locus of combination of 2 or more inputs that give the same level of output. Okay. Whatever be the point, it will give a combination of 2 inputs. For example, if you take OL labor is used, OC capital is used to produce A is 100 units of output. Whereas if you take B, the same 100 units of output is produced with L1 amount of labor, that is higher amount of labor with reduced capital, that is 0C1. In A, it is OC capital is used. OC, of course, OC is higher than OC1. So whatever point you take on the curve, it will show the different combination of these 2 inputs, that is labor and capital, that will give the same level of output. In most of the textbooks, they used to give ISOQuant means it is a combination of 2 inputs. Technically, it is not correct because we are showing a 2-dimensional, because the graph is a 2-dimensional. Okay, so that's why we are presenting 2 inputs. There are 3-dimensional graph also. You can include 3 inputs. So the advanced books shows that ISOQuant means it's a locus of combination of 2 or more inputs that gives the same level of output. So once you understand the concept of ISOQuant, then the next concept is ISOQuant map. So ISOQuant map is, you can see the right panel. So here you see 3 different ISOQuant. That is ISOQuant showing 100 as output level, ISOQuant showing 200 as output level, then ISOQuant showing 300 as output level. So when you have more than ISOQuant, that is different ISOQuants when you are presenting in a single graph, then it is called as ISOQuant map. It's a very simple thing. Then we have ISOQuant or budget line. So this is denoted as a straight line which is intersecting the budget, ISOQuant line. That is BL. That is, but this is a budget line. In some textbooks, it is given ISOQost. Both are same. ISOQost line or budget line are synonymous. Okay. So this shows that different combinations of inputs can be purchased at a given expenditure level. Okay. So from a given amount of income, you can go for different combination of inputs. For example, you have 100 rupees. Okay. So you want to distribute the 100 rupees to 2 inputs, maybe 50 rupees for labor, 50 rupees for capital. That is one combination. Another combination is 25 rupees for capital and 75 rupees for labor. That is another combination. Alternatively, 30 rupees for capital and 70 rupees for labor. So it means that the combination of 2 inputs are different, but you are spending the same amount, 100 rupees. Okay. So when you put this information pictorially, then it is called as ISOQost or budget. Now, as a manager or as a researcher, what you want to decide from this ISO account map and ISO account budget. So if as a business manager, you should take some decision. So which one is the right combination to purchase the input. So for that, the best combination is the intersection of budget line, that is the BL and ISO quant curve. So the intersection, for example, the intersection is at point A for the initial curve, point B at the subsequent, point C at the subsequent. So this intersection is the optimum combination which you can purchase. Okay. Now we have another concept called expansion path. Expansion path means it is a line which is connecting all the input combination. That is this line, okay, that is passing through the origin. So this line which is connecting A, B, C, and subsequently maybe some other isoforms. So this line is called as expansion path. So expansion path will give an idea about the different optimal input combination at different level of isoforms. So with the information so far we have discussed on production, types like average product, margin product, then total product, and again with the concept on ISO quant and budget line. So a person can take a decision in which region the firm can fix its production, and also what is the right combination through which input bundle can be purchased. Now let us move to the next. So whenever you are taking a decision on purchase, obviously you should know the different cost concepts. So in this lesson, that is lesson 5 in unit 2, the readers will be enlightened on concepts like fixed cost, variable cost, average cost, marginal cost. This is something like similar to the when you discuss about production analysis, like marginal product, average product, like that. So apart from this, we will also be discussing on break-even analysis, which is a very popular tool. That is, break-even analysis means it will indicate the point at which you have to shut down your business. Okay, that is, there will be no profit or no loss. So this lecture will give an idea about the different cost concepts and the break-even analysis. So these are the different topics we will be discussing in this lecture: the determinants of cost, then types of cost, then short-run cost-output relationship, then cost-output relationship in the long run, then concepts like economies of scale and diseconomies of scale, then which factors lead to economies of scale, and we will end with the break-even analysis. So now let us start with the determinants of cost. What are the different factors which helps to influence the first one is the level of output. As the output level increases, obviously the cost also, expenses also increases. Then price of the input factors. When the price of the input factors increases, obviously cost of production will increase. Similarly, the productivity of the factors of production. If the factors of production are highly efficient, then your cost gets reduced. Otherwise, cost escalates. And size of the plant. If the size of the plant is a little bit bigger, then economies of scale operates, then obviously it will reduce the cost of production. Then output stability. It has a positive relationship, certain inverse relationship with the cost. Then lot size, then law of returns. Then we have a level of capacity utilization. For example, if the firm is utilizing full capacity of the plant, then obviously the cost gets reduced. And time period. So if the time period is long enough, so a manager can take a better decision which helps to reduce the cost. Technology is one important factor. If you have cutting edge technology or cost reducing technology, that will help to reduce the unit cost of production. Experience also adds to that. A person with better experience tries to minimize the cost. And process of range of products. If a firm produces a diverse product, then obviously the cost also gets reduced. In supply chain, if the firm is having a better supply chain in logistics, then cost gets reduced. Government incentives also play a indirect role in reducing the It's maybe sometimes direct also through taxing. It reduces the cost level. So once we discuss the determinants of cost, the next one to be discussed is on types of cost. What are the different types that we come across in the literature? The first one is the actual cost or outlay cost or absolute or accounting cost. So this means that the cost or expenditure which a firm incurs for producing or acquiring a goods or service. An example is procuring raw material. Okay, this is the actual cost. Okay, so whatever you are spending, that is known as actual cost. Next is the opportunity cost. This you might have come across. So the opportunity cost is the cost of next best alternative foregone. Okay. That is the revenue which you would have earned by employing that goods or service in some other alternative uses. For example, if you take a person is owning a land, but the person will not pay any rent. Okay. Similarly, if a firm it owns a land, it will not pay any rent. So the rent is income foregone because it is not rented out. So this is an example for opportunity cost. Then we have sunk cost. Sunk cost means it's a retrospective cost, that is the past cost that have been already incurred and cannot be recovered. So once it is spent, you cannot recover it. Okay. Then historical cost is an example is the price paid for any item in the firm at its original time of purchase. Then we have a replacement cost. It's a easy thing to understand. That is the cost incurred to replace any repair in the item or any material. Then we have incremental cost. Incremental cost is the change in the cost caused by a given managerial decision. Then we have explicit cost. Explicit cost is actual cost that we have discussed already. One example is you are paying any wage to the labor. So that is an explicit cost. Then we have implicit cost. Implicit cost means, for example, as a person, sometimes you may work in your own company without any salary. Okay, so then but you are putting your labor and your skill, but you are not getting any reward for that. So then it is known as implicit cost. Then we have a book cost. Book cost means the cost which does not have any cash payment, but just only to take account of the to take advantage of the business transaction. It will be included in the accounting book. Then it is known as book cost. And the next one is the social cost. Social cost means the cost or expenses incurred by the society on account of production of goods or services. For example, cost spent on education. Okay, that is an example for social cost. And the next one is the transaction cost. The transaction cost means it is associated with the exchange of goods and services. Then apart from that, we also have controllable costs. That is the expenses which can be controlled by the executives in a firm or a company. That is cost under the controllable capacity of the executives. Then we have the shutdown cost. Shutdown cost means the cost incurred by a firm temporarily to stop its operation. So this is known as shutdown cost. Then in economics, we also have two specific costs. That is fixed cost and variable cost. The fixed cost means even if there is no any production, but there will be some cost involved. For example, a purchase of equipment, machinery, land. So these are all fixed input cost or expenses incurred in purchasing of any fixed input. Is known as fixed cost. That is, this cost will be incurred even if the production is zero. Then the next one is variable cost. Variable cost means the items or the cost which vary according to the level of output. As output changes, some cost, for example, if you take labor, So as output increases, the cost spent on labor also increases. So that is one example for variable cost. Of course, in the long run, there is no variable input. In long run, there is no fixed input. So because of that reason, in the long run, all the costs are variable. So you should know the basic difference between fixed cost and variable cost, because in the subsequent lectures, these two cost concepts will be widely used. So when we start the discussion on this chapter, I already told that as a business manager, you should know different things like demand situation, supply situation, then your idea on production condition, then of course the associated cost. So to know the different types of cost, so that it will help you to decide at what level you have to do the business, or you have to shut down the business. So for that, you should have some idea on different cost curve. Let us start with the total cost. Total cost curve is the summation of fixed cost and variable cost. We already discussed what is fixed cost and variable cost. The summation of fixed cost, that is FC, and PC is total cost. Then we have total fixed cost. Total fixed cost is the cost of all items spent on fixed input. Okay. So this total fixed cost, it will remain constant irrespective of the level of output. Then we have total variable cost. As I already told, the total variable cost changes with the level of output. Then we have average cost, like average product. Average cost is the ratio between total cost and total output. That is TC divided by TQ. This is given here. Then we have average variable cost. Average variable cost is the ratio between variable cost and level of output. That is VC divided by Q. Similarly, we have average fixed cost. That is fixed cost divided by Q. Then we have marginal cost. That is marginal cost is similar to marginal product. Here, the marginal cost is the cost of producing an extra unit of output. That is change in the total cost due to change in the total output. Okay, that is delta TC divided by delta Q. So this you should keep in mind. This information is also given in the study material. If you have any doubts or any clarity, you can read once, and if you still have any doubts, we can discuss in the subsequent class also. So whatever we have discussed in the previous slide, that information can be depicted visually also. For example, if you see the left panel, this shows the relationship of cost and output. Okay. The horizontal axis shows the level of output, and the vertical axis shows the different cost. As I already told, variable cost. Variable cost, when the output is 0, variable cost will be 0. As the output increases, variable cost also will increase. Okay. What about the fixed cost? As I already told, fixed cost has no connection with the output. Whatever is the level of output, fixed cost will be same. Okay. So this fixed cost is the line parallel to the horizontal axis. That is the maroon line. And what is the total cost? The total cost is the summation of total variable cost and total fixed cost. So obviously, the total cost will have its starting point from the total fixed cost. Then it will have the same shape like TVC. Okay. So total cost and total variable cost will have the same shape, but only the slope slope differs, okay, by the amount of fixed cost. Then if you see the left panel, you have other costs like average fixed cost. Average fixed cost, all the average cost will slope downwards up to some point, and then it gets increased. Similarly, marginal cost also, it stops up to a certain point and then it gets, it increases. So in this left chart, you can see clearly that the marginal cost cuts the average variable cost and average total cost at their minimum level. Okay. So if you see, this is the minimum point for average total cost, and this one is the minimum point for the average variable cost. So based on this graph, a manager can take some decision. That is when to stop the production or whether to continue the production. So for that, you should have some idea about the cost schedule. Like production schedule, we have been discussing about the cost schedule. So here the table shows the different output produced by incurring some expenses on some inputs. For example, to produce zero output, as I already told, even when the output is zero, there will be some cost involved in producing the fixed items, fixed inputs. Okay, that is what mentioned here as 300. Okay, so the variable cost will be zero because output is zero. Obviously, variable cost will be zero. So in this case, actually here it should be 300. Okay, then the next one is the output at 1 unit. What happens? The total fixed cost, as I already told, it is going to be the same because it is constant. It will not change with respect to the change in the output. Only variable cost will change. So based on the change in the variable cost, you just add the variable cost with the total fixed cost, then you will get the total cost. For example, 300 plus 1,500, that is 1,800. Then 300 plus 1,700, 2,000. Like that, you can get the total cost. Then we have average fixed cost. Average fixed cost is total fixed cost divided by level of output. That is 300 divided by 1. That is 300. Then 300 divided by 2, we have 150. So like that, we have average total cost. Then average total cost is total cost divided by number of output. Similarly, we have average variable cost. That is average variable cost is total variable cost. That is 1,500 divided by 1. That is 1,500. Then we have 1,700 divided by 2. And we get 850. So these are all very simple things. So once you know the definition of different cost concepts, so it is very easy to capture the information presented in this cost schedule. So when this information is plotted in a graph, it looks like this. Okay. So here, if you see the average total cost, the average total cost slopes downwards. Similarly, if you see the marginal cost, that is the violet line, and the average fixed cost slopes downwards. Only the fixed cost will be a straight line. Okay, this is the nature of the average fixed cost, average total cost, and marginal cost curve. Similarly, if you see the cost curve for the other items like total fixed cost will be a straight line. As I already told that irrespective of the level of output, the firm will incur the same total fixed cost. Okay, that is why we see a straight line. Then we have total variable cost denoted by green line. So this total variable cost shows the increasing trend. So the same shape will be witnessed by the total cost. The only difference is the distance between total cost and total variable cost will be equal to the total fixed cost. Okay. So this is very simple to understand. So once as a manager, you know the shape of the curve for your firm, then you can take some business-oriented decision. So how to take some decisions? So before that, let us see the relationship between marginal cost curve and average cost curve. So this already we discussed, but to give better clarity, I am presenting in a separate slide. If you see this chart, you can see the marginal cost and average total cost curves are U-shaped. This U-shape is because of the law of diminishing returns. Because as the firm increases its quantity of output, the cost will get reduced, because initially the firm will be efficient, but after some time inefficiency creeps in, and that will lead to increase in the average cost. Okay. Then the MC curve, that is marginal curve, cuts the ATC, that is average total cost, and average curves at their lowest point. This also I already indicated. Then the MC curve cuts the AVC from the below, that is MC curve, the green line, that is it cuts the average cost, that is both ATC and AVC from below. So when the ATC curve is above the MC curve, then AC is falling. That is ATC curve. This is the ATC curve, and the ATC curve is above the MC curve up to this point. So up to this point, average cost will be falling. So after that, average cost will be increasing. So similar, we call pattern you can notice for average variable cost also. So up to this point, you can see the decline of the average variable cost. After this point, you can see the increase in the average variable cost. So the intersecting point, that is average, this point, the average total cost and marginal cost curve. So this will give an idea about that optimality condition. Okay, so if you want to produce high level of output with minimum cost, then you have to choose this region. Okay. If you want to increase output, but many people might be asking questions, because here if you see the quantity is less, but some people may be asking why we can still increase the quantity. Okay, you can increase, but if you are increasing the quantity, what will happen? The marginal cost will increase further. So then it will lead to loss. Okay, so if you want to be in a better position or in a remunerative side, so you stop the business at this point. Okay. So I think we are running up of time. So what I will be doing is I will be closing the lecture for today with this explanation. So tomorrow I will continue with the discussion on the same optimum output.
Thank you, sir.
Okay, sir. If you have any doubts or any clarification, you can ask me now, or else you can email me, or you can text me to my mobile also.
Okay, thank you, sir.
Thank you. Thanks for joining, and have a nice day.
Thank you, sir.
Thank you, sir.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.
So your mobile number.
My mobile number is can you please note down? 8989.
Yes, sir. 89.
89290.
290.
89290 636.
636.
445. Otherwise, I can present in the slide. So you can see in the slide. I think it is visible.
Okay, sir.
So 89290 63645. Or else you can write an email.
What time repeat it?
Yes, sir. Okay, sir.
What time repeat it?
Pardon?
Last minute.
What time repeat
Okay,
it?
sir.
Phone number.
Thank you, all of you. And with this session, we are come of this today's PCP classes. And tomorrow classes will be started by 10.
Thank you, ma'am.
Doubts?
Thank you, ma'am.
You can ask.
Thank you, ma'am. Thank you. Thank you.
You just a little loud. I'm not able to hear
Thank you.
Ma'am, is WhatsApp created?
No, WhatsApp group is not created. You will have to add this WhatsApp number. If you have any doubts, any clarification, you can just send a message, we will reply.
Which number? To which number?
9486
9486
00
00
7677
777
77. I'll repeat 9486 00
00
7677.
Okay, ma'am. Thank you, ma'am.
Okay, thank you.
Thank you, ma'am.
Thank you, ma'am. Thank you, ma'am.
In the night.